फ्रेंड्स, वेलकम टू दिस क्विक रिवीजन सेशन ऑफ JAIIB PPB मॉड्यूल बी। अगर आप JAIIB के लिए प्रिपेयर कर रहे हैं और पूरे मॉड्यूल बी PPB के मॉड्यूल बी को सिर्फ कुछ घंटों में रिवाइज करना चाहते हैं तो यह वीडियो आपके लिए परफेक्ट है। इस वीडियो में हम सबसे इम्पॉर्टेंट कंसेप्ट को सिंपल तरीके से समझेंगे, सिर्फ वही पॉइंट जो आपके एग्ज़ाम के लिए मैटर करते हैं। चाहे आपका पास टाइम कम हो या बस एक क्विक रिफ्रेशर चाहिए बिफोर द एग्ज़ाम, यह सेशन आपको सब कुछ जल्दी समझाने में मदद करेगा। एंड तक साथ बने रहिए और मैं गारंटी करता हूं कि आपके एग्ज़ाम हॉल में ज़्यादा कॉन्फिडेंट फील करेंगे। जंप इनटू द वीडियो। द फर्स्ट थिंग यू हैव टू सी is regarding the types of borrower. As you can see, there are different categories of borrower. Borrower can be individual, borrower can be firms, it can be HUF, it can be trust, it can be cooperative societies. And now eligibility. If we talk about eligibility, to borrow you need to be of sound mind. Minor under 18 can't borrow money. Remember this is very important. Next thing is contract. Contract is regarding contract, remember that minors and people who are not mentally sound can't enter into legal contract. Now married women. So married women can borrow money if they are married. Their husband is only liable if he is a co-borrower. See, try to understand this thing, very important. Now if we talk about the legal model for the business, first case is Pardanasin women. So what is this? These are women who follow strict social customs. They can enter contract, but their identity need to be verified carefully. So this thing you have to keep in mind. Next thing is illiterate person. So illiterate person, if someone can't read or write, they can use thumbprint or mark instead. Witness must be present and their explanation should be recorded. So this thing you have to do in the case of illiterate person. Now let's talk about the business types. First thing is proprietorship. So this is business owned by one person and the owner has unlimited liability, meaning they are responsible for all debt. The owners are responsible for all debt. Next case is partnership. This is a business where two or more people, 2 plus 2 or more people are share profit and responsibilities. It is governed by the Contract Act. Remember this point. Now next thing is regarding the partnership. So partnership essential is that a partnership is when 2 or more people come together to run a business and share the profit. Next thing is registration. See, registering a partnership is not required, it is optional, but it is good idea for legal protection. Next thing is implied power. Trading partner can borrow money or pledge asset, and non-trading partner have more limited power. Remember the difference. Trading partner can borrow money or pledge asset, but non-trading partner have more limited power. Now if we talk more about this partnership firm, suits. Registered partnership firm can sue other in the court. That is why registration is essential, is a good thing. Now authority. Partners must agree and give authorization for major business decision. Next thing is banking. Banking operations should follow the partnership deed, right? And ensure operation as per deed. And if a partner pass away, the bank transaction may be halted. Remember this thing. Question may be asked. Case study can be framed on all these things. That halt on partner's death. Next thing is regarding the HUF. HUF means Hindu undivided family. So an HUF include lineal male descendant, their wives and unmarried daughter. Now it is managed under Mitakshara in India and Dayabag in Bengal. These are traditions. Now Karta is the senior male. He is called Karta and he manages the family affair and can borrow or sell asset for the family benefit. Next is banking. The Karta handle the borrowing for the family and other adults in the family are responsible for the debts. Now let's talk about companies. Companies is a separate entity from its shareholder, and one case study is given in your book, Salomon versus Salomon. This case study was asked in the previous year, so I request you to go through this case study because the concept inherent in this case study will be asked. So remember, companies is a corporate personality. It is separate from shareholder. Okay, it is a separate entity from its shareholder. Next thing is limited liability. Shareholder liability is limited to their investment in the company. Next thing is characteristics. Companies are voluntary, continue to exist and independently and can be sued or it can sue. Now let's talk about the types of companies. So types of company include private company. Private company means share transfer is restricted and up to 200 members max. Public company, share can be freely transferred, and here is the no limit on the number of member. Government company, 51 plus more than 51% of the share are owned by the government. One person company, owned by only one person. The limit on capital and turnover. A small company, capital is up to 2.5 crore and turnover is up to 2 crore. Now if we talk about the Indian companies law, the first is foreign company. Foreign company is incorporated outside and it operates within India. Next thing is holding company. So holding company control another company by holding a majority of the voting power or board control. Subsidiary company. Subsidiary company is controlled by a holding company. Companies Act 2013. It governed company registration and management. Now if we talk about formation, public minimum 7 plus means minimum 7 member. Private minimum 2 members. OPC 1 member, minimum 1 member. Now if we talk about MOA, that is Memorandum of Association, it defines the company scope, company name, company objective, company liability. And if we talk about Article of Association, it contains internal rule, including director rule and the borrowing powers. If we talk about COI means Certificate of Incorporation. It is issued by MOA registration. After registering the MOA, COI is issued. If we talk about the non-trading companies, it is governed by either the Companies Act or the Cooperative Society Act. Now let's discuss about the lending to trust. So if we trust, first thing is governance. It is governed by the Indian Trust Act, Public Authority Act and WAF Act. Permission, it ensures the trustee has authority and legal permission to borrow. Supervision, it is supervised by the Charity Commissioner or WAF board. Now let's talk about the LLP. LLP means Limited Liability Partnership. It has been formed under the LLP Act 2008 and require at least two partner with one Indian resident. Liability, each partner's liability is limited to their contribution. Governance, the LLP agreement details the right and duties of all the partners. Credit facilities, now contribution limit is that contribution is up to 25 lakh, turnover up to 40 lakh. Documents, incorporation certificate, PAN, address proof, LLP agreement. These are the documents which are required. Next is types of credit facility. Fund based, it includes cash credit, overdraft, term loan, bill finance. Remember this thing. And non-fund based, guarantee, letter of credit. Now if we talk about loan portfolio, retail loans include vehicle loan, education loan, credit card, personal loan, small business loan. Commercial loan include term loan and working capital loan. Now working capital, the purpose of working capital is used for daily operation. There's two terms: gross working capital, which includes total current asset, and net working capital, which includes current asset minus current liability. If we talk about risk versus profitability, more working capital means lower risk but can reduce profitability, right? So these things, more working capital, lower risk but reduce profitability. If we talk about the finance option, so cash credit allow the borrowing up to a limit. Overdraft means what? Provide extra fund for short term needs, futures. Now next thing is bill finance is what? So we are talking about this bill finance. Bill finance is finance receivable through method like bill discounting and bill purchase. Next is guarantee, right? Guarantee means what? Guarantee is assurance provided by a bank for third party obligation. Letter of credit, bank promise. So these are the finance options. So long term fund used for purchasing fixed asset like production facility. If we talk about fund based working capital, then we have cash credit for working capital need, overdraft for occasional short term finance, bill finance. So bill finance, it helps with the financing receivable. There are two methods: by either bill discounting, this means bank pays in advance for a bill and recover interest. Bill purchase, that means bank buy the bill from the business and advance against the bill. Business get an advance based on the bill. Now if we talk about the types of bank loan, so one is short term loan up to 1 year. Term loan is used for capital expenditure, remember it. And short term loan up to 1 year, medium term loan 1 to 5 year, long term loan more than 5 year. Now if we talk about demand loan are loan that are payable on demand or on fixed schedule. Bill purchase means the bank buy demand bill at a discount and advance against bill. So purpose of bill purchase is what? The purpose is that it helps business get immediate cash by selling their bill, and advance against bill means that provide cash credit or overdraft based on the bill that are under collection. So it is used to get fund while waiting for the bill to be paid. Drawer bill acceptance, the bank pay the seller when the buyer bill accepted. So it ensures that seller get paid promptly when the buyer accept their bill. Bill acceptance, also called co-acceptance. The bank added acceptance to the borrower accepted bill to provide extra credit support. Non-fund based facility, its definition is like, it is like a contingent liability that don't involve direct financing. It example include bank guarantee and letter of credit. If we talk about types of non-fund based guarantee, the first type is bank guarantee. So bank guarantee is the bank promise to cover the borrower default, and performance guarantee is it ensure that a contract will be completed. Financial guarantee, it support working capital need. Deferred payment guarantee, it guarantee future payment. A specific guarantee, it includes bid bond, earnest money, advance payment and retention amount. LC, letter of credit, the bank ensure that the payment to the seller on the behalf of the buyer. It is governed by UCPDC 600. Now if we talk about underwriting and credit guarantee, the bank agrees to fund a borrower if they fail to raise or repay money. Note, less common now due to the rise of merchant banking. Due to rise of merchant banking, this underwriting and credit guarantee has become less common. If we talk about other credit facility, so fund based we have, which includes loan overdraft, and non-fund based, which include guarantee LC. Derivative product, it is used to hedge against currency and it helps reduce exposure to market fluctuation. Then we have consumer credit and retail asset business. If personal loan, credit card, vehicle loan, these are included under it. If we talk about the cardinal principle of lending, we have safety, liquidity, profitability, purpose, risk diversification and security. So safety ensure that the borrower can repay the loan. Liquidity ensure that the assets should be convertible to cash. Profitability means the loan should generate income. Purpose means clear understanding of how the loan will be used. Risk diversification means spread the risk across different sector. Security means loan should be secured. And one thing you must keep in mind, there are 7 C concepts related to our PPB unit number 23. So let's get started. Ever wondered how bank decide whether to give you a loan or not? It is not just a luck. It is a process named as credit appraisal. So let me break it down for you in simple term. Credit appraisal is just like a health checkup but for loan. The bank check if the loan is safe, if it can be paid back on time, and if it is profitable for them. They want to make sure that the borrower won't run into trouble paying it back. Now objective, the main goal, to decide if the loan should be approved or rejected. This depend on borrower financial strength and the market condition. Next question is how it work. From the moment you apply to when you get the loan, the bank through a detailed process. The process is like verifying your details, then comes checking your business and visiting the site and reviewing your document. Now bank are cautious because there is always a risk you might not pay the loan back. They look at your credit history, right? They look at your credit history and business record and even report from credit rating agencies. You know about CRA? So they look at report from the credit reporting agencies, right? Now management assessment. If it is a business loan, the bank will also evaluate the people running the business, like the promoter, the board, the CEO, the member, to see if they have the right experience. Now let's talk about the 7 C's criteria for decision. Now how does the bank actually decide? They use something called 7C. Remember, this question is asked in the previous examination. The first is called credit worthiness. Credit worthiness means how healthy are your finance, right? So and there are 4 lending parameters which you must know. What are the lending parameter? So the lending parameter is credit worthiness, loan purpose, cash flow and collateral. Remember these 4 lending parameter. Again repeating, this is the cardinal principle of lending: credit worthiness, loan purpose, cash flow and collateral, right? Now let's talk about the 7 C's. The first is credit worthiness. How healthy are your finance? Next is character. Do you have integrity? Next is capacity. Means how strong is your finance base? Can you repay the loan? Capital means how strong is your financial base? Collateral. What security are you offering? Condition. What are the loan terms? Cash flow. That means can you generate enough income to repay? They mainly focus on your ability to repay, which is super important to avoid bad loan. Now if you talk about the business loan, this is applicable to all kind of loan, but if we specifically talk about business loan, when it comes to business loan, bank want to know why you need the loan. Is it from short term profit, or is it from long term growth, or something as speculative? They assess how well your business can keep running and generate cash to repay the loan. Now collateral is the backup plan. So you can see the loan type is capital investment, working capital, and personal loan they also give. If we talk about the collateral is a backup plan, but bank prefer that you repay through your business earning, not by selling of asset or borrowing money. So in a nutshell, credit appraisal is a careful evaluation of to make sure the bank is lending safely. They look at your financial, your business, and most importantly whether you can repay the loan on time. Now let's talk about the loan categories. So you can see the repayment sources are there, assessment focus, preferred repayment source. Okay, obviously preferred repayment source is business operation, not asset sale. Again, I have told you. Now if we talk about the loan categories, so loan comes in different shape and size, whether you are running a business or managing personal need. Let's quickly break down the type of loan and talk about the important concept of business, which is called working capital. So there are two main category of loan. The first is called business loan. These are for things like working capital or big expenses like building machinery or land. The next is called individual loan. These are for personal need like buying a home, buying a car, or even electronics. Now if you talk about the handling loans, business loan are handled by a specialized team, so since they are more complex, but personal loan are often standardized and tech driven, making the process faster and more efficient. Now let's talk about the working capital. See, let's dive into working capital, which is basically the money business need to cover their everyday cost like buying raw materials, paying salary, and stocking inventory, right? You know about working capital. What is the meaning of working capital? Now there are some terminology which you need to keep in mind, right? So first thing is gross working capital. So gross working capital means what? The total amount of current asset a business had. Like when I say current asset, it means like a cash, right, and products. So whatever current assets business had, that is called gross working capital. Net working capital is a more important number. It is what left after subtracting current liability. When I say current liability, so suppose there are some bills to be paid, right? So suppose there are bills to be paid, so current asset minus current liability means it is what left after subtracting current liability from current asset. This shows that whether the business can easily meet its short-term expense or not, right? So it is crucial to have a healthy net working capital. So it is crucial. So what does NWC indicate? NWC indicate whether business can easily meet its short-term expense or not. So it is crucial to have healthy NWC. Ideally a ratio of more than 1.1 is greater. This means company has enough liquidity to cover expense. A business also track the working capital gap, which determine how much working capital is needed from the bank. So this working capital gap means it is basically difference between current asset and liability excluding bank borrowing, and it used to determine working capital limit, means how much working capital is needed from the bank. Now working capital includes things like raw material, WIP, work in progress, finished goods, and payment out to the business. These things change depending on the company size and how they operate. If we talk about the operating cycle, let's move to the next slide and talk about the operating cycle. You can see it here, working capital and operating cycle. So every business run on an operating cycle, a continuous process of buying raw material, turning them into fixed goods. So first of all, we buy raw material, we turn them into finished product, we sell them, and then use that cash to repeat the cycle. Here is how it works. First of all, you purchase the raw material, the material goes through the production, turning into a product, that the product are sold, but cash may not come in right away due to payment delays or credit terms. The cycle repeats. The money from the sales is used to buy more raw material. So whether it is managing loan or working capital, business need to keep an eye on how their cash flow to run smoothly. That's why understanding working capital is super important. It's keep the wheel running. Now let's talk about this how business figure out the amount of working capital they need and how bank help cover the gap when fund run low. This is important for business to keep running smoothly. So now let's talk about the bank financing for working capital. See, when a business need more money to cover its day-to-day operation, bank step in to help fill the working capital gap, right? Working capital gap. So there are several methods they use to assess the need. So there are some common way bank assess working capital need. The first is called turnover method, second is operating cycle method, third is called maximum permissible bank finance MPBF method, and the fourth is called cash budget method. These methods help bank figure out how much money a business really needs to stay afloat. But before bank lend any money, they need to understand the business. Here is what they do, that is called assessment process. They check if the business have been successful in the past and they look at the future plans. The business submit a detailed plan with projected numbers like how much money they expect to make and spend. Bank also review trends in how the business had used fund before and if it might need more money going forward. So one common method is called turnover method, mainly used for a small and medium enterprise, right, with working capital limit up to 25 crore. Remember this limit, very important. So MSE, medium and small and medium enterprise with working capital loan up to 25 crore. So here how it works. See, it works like the bank look at the projected annual turnover of the business, right? 25%, suppose that this is 100 crore. So 25% of this annual turnover is considered the working capital need, right? So 25% is considered the working capital need, the 25% will be financed by the bank. We will be the need of the working for the short term needs, working capital needs, short term needs, and for this 25 crore the bank will finance 20%, means 20 crore, and the remaining 5% is to be borne by the borrower, right? Now let's talk about the operating business cycle. So every business has an operating cycle, which is the time it takes for a company to turn raw material into product and sell them. The typical cycle is around 3 months. It is considered that it is assumed that a typical cycle is around 3 months, but this can vary depending on the business. So in a year there are 4 quarters, right? So now let's talk about working capital limits and withdrawal. Once the bank has assessed the working capital need, they set limit on how much the business can withdraw. The amount they can take out depend on their current asset like stock and debtor, after deducting a margin for safety. Now let's talk about the next method, that is called operating cycle method. Another traditional method is operating cycle method. It estimates how long the company hold on assets like inventory and how quickly they pay off the liability. This helps the bank gauge the actual financial cycle of the business. In short, business need to know how much working capital they require, and bank use various methods to help them figure that out. This ensures that company can continue running without running off the cash. Now let's come to the next slide and let's discuss bank usually let's talk about how bank provide finance for working capital and the challenges faced by small business, especially when it comes to collecting payment. Bank usually lend money only for raw material that are fully paid for, meaning if a company bought material on credit, they won't get bank finance for it, right? So suppose a company bought material on credit. So say they have already taken the material on credit, so credit purchase is excluded, right? So bank will not pay for that. Similarly, bank only finance finished goods after deducting any advance payment that were already made. So only finished goods net of advance payment need bank credit. That's the point. These two things you have to remember. A small and medium enterprise often struggle with collecting payment, right? Especially from big company. This can really hurt their cash flow and make it tough to keep business running smoothly. When bank assess how much working capital to lend, they ask for document like age-wise list of creditor and debtor, and they also require business to submit a stock statement showing their current inventory. Bank only consider debtor. Debtor means what? Debtor means people who owe the business money. So bank only consider debtor if their dues are outstanding for up to 180 days. Right. If a business has creditor, means people they owe money to, bank subtract that from the eligible debtor, right, when calculating the loan. The RBI recommend that bank focus more on how well a business is performing and what its future projection looks like, rather than just looking at the security the business offer, right? So this is the RBI assessment, right? RBI working group, which is Sri PL Tandon. So you can see what they have shown. Okay, borrower performance. Now lending for working capital, that is called RBI norms. The RBI does not have a specific rule on how business should classify their inventory or receivable when applying for working capital loan. This gives business some flexibility in how they present their finance. Now next method come MPBF, that is called maximum permissible bank finance. One common method bank used to figure out how much to lend is MPBF. There are two methods. In method 1, the borrower has to contribute 25% from the long term fund, while bank covers 79% of the, I think is 75, not 79, it is 75. The bank finance 75% of the gap, of the remaining gap, right? And so bank finance, so from the long term fund borrowers should contribute 25% and the bank finance 75% of the gap raised from the long term source. Now what does method 2 say? Method 2 say that the borrower must contribute 25% of the total current asset from the long term fund, right? So 25% of the total current asset should be contributed by borrower from the long term fund, and the bank covers the rest, right? So these two methods are there. So to summarize, while bank provide critical working capital finance, SME often face challenges, especially with collecting payment. Understanding how bank assess and lend working capital can help business better prepare. Now let's talk about the method 3, I think, right? So let's continue exploring how bank lend money to working capital and introduce you to a key method. And before that, method 3 said that which is academic interest only propose funding core current asset plus 25% of the balance from long term. So this MPBF is to be used when with CMA format for credit monitoring. CMA format, you know, there are various type of forms. You can see form 1, form 2, form 2 to 6. We will discuss in detail about this CMA forms. And then let's talk about the next method that we have. Yeah, so you can see it here that let's continue exploring how bank lend. Okay, bank use various form to assess, can keep track of how much working capital a business need. Here is a quick look at this form 2. First thing is form 2. You can see written form 2. So form 2 check whether how much money the business owe to the creditor and if it is making enough provision for taxes and other obligation or not. It is also ensure that intangible asset like patent and goodwill are written off. Form 4. What does it do? This form help calculate the maximum permissible bank finance, that is called MPBF, right? It look at export bill and limit for draft purpose. So we can skip this part because this question will not be asked. Let's directly jump to the cash budget method, right? So what is cash budget method? Cash budget is a statement that shows all the cash a business expect to receive and spend over a period of time. So this is called cash budget. It is a statement that shows what kind of payment business will receive and what are you spending. So it is based on projection of future operation and help business manage their working capital. This budget include categories like business expense, non-business expense, capital account, sundry item. Now, while a cash budget is a projection of what is expected, a cash flow statement is historical. Let me move to the next slide. So what I have told you, this cash budget is nothing but a projection, right? So but this cash flow statement is a historical. It shows what has already happened in terms of cash receipt and payment. Both are important, but the cash budget focus on future needs. So in a nutshell, bank use various forms to make sure business are managing their working capital effectively. For bigger businesses, the cash budget method plays a crucial role in ensuring the right amount of finance is available for smooth finance. Now let's dive into how bank manage cash flow for business using the cash budget method. A cash budget is drawn up for a specific period, usually 12 months, 6 months and 3 months, with quarterly period being the most accurate. The business projected cash receipt and payment month by month to see if they will have a surplus, that means extra cash, or there is a deficit, right? So if there is a surplus, they can reduce the amount borrowed from the bank, and if there is a deficit, their cash balance goes down. So cash budget are especially useful in industry where cash flow fluctuate, right? So cash flow fluctuate especially in those industry like seasonal business, construction, software development. The biggest cash deficit during the period determine how much working capital the business will need from the bank. The peak cash deficit. So peak cash deficit show how much total finance the business will need. The borrower is expected to contribute, that is net working capital, that is a borrower contribution, margin money we can also say it. The borrower is expected to contribute 25% of their peak deficit, which actually withdrawal, while actual withdrawal be made based on the monthly cash shortfall. So the advantage is that this method is that unlike traditional loan, they rely on security. The cash budget method, traditional loan rely on security, but cash budget system is a short-term lending option. It helps business plan their cash flow better, identify potential financial problem early, and manage credit more effectively. Now let's look at some non-fund based facility, which includes bank guarantee and letter of credit. Bank guarantee is the promise made by the bank to cover the business obligation if it cannot pay. The bank checks the business credit worthiness, and this guarantee can be either permanent or for a specific need like deposit or contractual obligation. LC, LC is an assurance from the bank that it will pay the seller on behalf of the buyer, and there are two types, DP and DA. DP means what? Document against payment. The bank pay the seller only when buyers make the payment, and DA means what? The bank pay the seller when the buyer agree to accept the good. Now LC limit assessment. So the bank calculate LC limit based on how much raw material the business expect to buy, how long it will take for shipment, and credit period. Remember, the question of numerical question are asked from LC limit assessment. Friends, if you are interested to get such type of PDF, short concise PDF, you can enroll in our capsule course program. In capsule course program, we provide you such type of PDF. For more detail, you can WhatsApp me on the number shown on the screen. Now let's talk about term loan assessment. Term loan are for big ticket item like land, building, machinery. Unlike working capital finance, which cover day-to-day operation, term loan are paid back from business future earning. However, they carry a higher risk for bank since they are for long-term investment, right? So let's talk about the how bank assess project cost for new business and how they determine whether to approve loan using a measure called DSCR, that is called debt service coverage ratio. See, when starting a new business or buying major asset, bank need to know the total project cost. See that it is include the cost of buying capital asset like land, machinery and equipment, what are the expenses for building construction, other related cost and the working capital margin. Once the total cost is clear, business need to show where they are getting the money. This could be from their own fund, investor or loan from bank. Everything is listed in a table that summarize the project cost, right, and the source of finance. Now let's dive into DSCR. DSCR is called debt service coverage ratio, which is how bank decide whether a business can afford to pay back the loan or not. Business prepare profitability statement that show expected earning over the loan period, right. So the DSCR is calculated by dividing the cash available to pay debt by the actual debt payment for each year. So it is how determined. First of all, we divide the cash available to pay debt. How much cash is available to pay debt, and it is divided by the actual debt payment for each year. So a DSCR of 1.50 or higher means the business has enough cushion to safely repay its loan. Means how much cash is available to pay debt. Suppose I have to pay a debt, and how much cash is available with me, divided by actual debt payment for each year. So the higher the DSCR, the more comfortable the bank feel about lending money, right. So sometimes it happen in the early year of the business, the DSCR might be less than 1.50. In this case, bank will keep the loan installment lower initially and then increase them later when the business start making more income. Alternatively, they may extend the loan period to make payment easier. So when it comes to getting a loan, bank carefully assess both the project cost and using DSCR to make sure a business can comfortably pay back the money. So that was. So now in the first slide, let's quickly talk about the two different types of two key system that bank use. Two key system that bank use to set interest rate. That one is called base rate and other is called MCLR. Right, this is the base rate system. See, the RBI made loan rate flexible and set rule for how bank decide them. So that is called RBI deregulated loan interest rate, and replace PLR as the benchmark, ensuring transparency and a single base rate per bank. Bank now use base rate to ensure fair and transparent rates. This base rate is reviewed quarterly, remember it, every 3 months, and no loan can be below this rate. No loan can be given below this rate. So hopefully this concept is clear. Now earlier it was PLR and now PLR has been replaced with base rate system. Then come MCLR system. MCLR replaced base rate as the new benchmark, new standard. It includes something called cost of fund. It spread include credit risk and tenor premium. Two things are included, right. It includes cost of fund and a spread. When I say credit risk, it is basically nothing but so you can see MCLR plus a spread form the lending rate. So see, there is something called MCLR, and when we add some spread and this after addition it becomes our lending rate, right. So which is like a small extra charge. What is this spread? So this spread is nothing but a small extra charge to cover risk and time taken for the loan. You see, I have told you this spread include two things. First is credit risk. When I say credit risk, it means to cover risk, credit risk, and tenor premium. Tenor premium is time taken for the loan. And now there are two kind of rate. One is called floating rate, another called fixed rate. Loan with floating rate follow MCLR. Like floating rate or reference is MCLR, while fixed rate loan must be at or above MCLR. Right, and bank adjust it every month, right. You see, one thing you have to keep in mind, the frequency of adjusting. Let's move to the next slide. It is adjusted every month, right. So you can see it here that in the case of in the case of agriculture loan, special norms for agriculture loan, interest rounded to the nearest rupees. A small loan and takeover rate for a small loan based on total cost and return. No lending below benchmark. So loan linked to benchmark can't be below the specified rate. Obviously these are the specific rate. Now MCLR post April 1st 2016 used for floating rate loan. External benchmark applied to certain loan. MCLR component must keep in mind, very important thing. There are 4 to 5 components. First is marginal cost of fund, second is negative carry, third is operating cost, and fourth is tenor premium. It is higher for long tenor loan. So remember these are the 4 components. I am again repeating: marginal cost of fund, negative carry, operating cost, and tenor premium. And publication and review, bank publish at least 5 MCLR reviewed monthly. Now if we talk about the MCLR norms, let's talk about the spread. So MCLR norm, spread in MCLR is based on how risky a borrower is, right? It increases, spread increases only if the borrower risk goes up, right? Now some loans like government or a special scheme loan follow different pricing. These are exempted loan called WCTL, FIT, government refinance loan follow specific pricing guideline. Loan for depositors, loan for employee, loan for small businesses can be linked to external benchmark like the repo rate. Next, let's talk about the credit management. See, this is how bank manage loan from approving to monitoring. It includes loan assessment, approval, monitoring. Loan are reviewed based on capital limit, risk and borrower rating. Right, these are the important thing. So RBI set limits for single group exposure. Go through this is very important. How much exposure is for single, how much exposure is for group, we have covered in detail in our detailed comprehensive plan. Now since this is a quick revision plan, so I am skipping some portion, so I am telling you this is very important, please go through it. Now there are also a strict rule for real estate, foreign policy, everything. So you can see for group exposure it is capped at 25% of tier 1 capital. For sector and foreign exchange exposure, internal limit for sector, FX risk, foreign exchange risk above $10 million US dollar needs board approval. For real estate, you can see SEZ South Economic Zone treated a commercial real estate. For leasing and foreign venture, 10% limit on leasing. Foreign joint venture capped at 20% of the capital fund. Now there is something called credit audit. So bank monitor credit to prevent bad loan (NPA) by checking financial report, performance and early warning signal. That is called EWS. Let's see, you can see it clearly that now audit scope, it covers portfolio, loan review, corrective action, focus on compliance and everything. Now that's quick look at these key concept in banking. Now let's talk about the credit monitoring. Bank track important financial number like current ratio, like stock statement, financial ratio, performance, focus on early warning signal. If a borrower don't follow the rule, bank can take action, right? Some tools are there for credit monitoring like MSOD, QIS, inspection, right? Audit report, financial reviews, right? So the current ratio, debt level, data turnover, these are the financial covenant. And non-compliance will cause action like rate hike, frequency statement, loan recall, stock audit. So these are some steps taken by the bank if borrower don't follow the rules. Now some tools have been given like section report, stock and audit report, financial, project cost statement, cash budget, RBI inspection. These are the monitoring tools. And there are some monitoring steps like identify NPA, contingency support, scrutinize statement, visit factory. Scrutiny may be done quarterly, half yearly review of sales, profit, cost, everything. Now the next some common terms is there. Now there is some terms like QIS3 in QIS3 review. It evaluates financial, sales, compliance and efficiency. Credit risk rating, it is reviewed periodically with remedial measure. Loan account review, notice is sent to the customer. High risk account monitored closely. CRILC, information sharing platform for large credit, threshold is 50 million. If we talk about the non-cooperative borrower, the report following a specific guideline. So loan over 500 million rupees suspected of fraud, it should be reported to CRILC. Okay, red flag. Now let's talk about this early warning signal, EWS. These help bank detect fraud early. Next is security. Loan are backed by asset, which can be primary asset or it can be personal guarantee. So primary includes financial asset, collateral or personal guarantee. Now there is something called margin. A portion of the asset value is set aside to cover risk. There are charges like fixed charges, floating charges. Fixed charges include a specific asset, floating include present or future asset. Finally, credit risk management ensure bank control risk by setting limits and reviewing loan carefully. That's a quick overview of how bank monitor and manage risk. Now there is something called you can see credit risk management. In this we identify, measure and control risk, right? Now let's talk about the operational process of the handling loans. So see, first thing is loan application. Whenever someone apply for a loan, their details are entered into the system and necessary documents are collected. The loan is evaluated based on factors like RBI guidelines, credit report and collateral. Right, RBI guidelines, exposure limit, loan amount, promoter background, technical feasibility. On this basis evaluation is done. The second thing is loan sanction and disbursement. Different people or different committees approve loan based on the type and size of loan. Right, power delegated based on the loan type, size, obviously. So after approval, the loan is released once all formalities are completed. right? That is called disbursement. Term by sanction letter, document charge created, loan release after formalities. Now then there is something called monitoring and repayment. So bank regularly check how the loan is being used and if assets are secure or not. Now loan repayment can be made via cash, check or online transfer. That is called disbursement. Repayment terms. Now there are some special terms. Let's discuss that. See, loans secured by goods use either the hypothecation, remember it. So those loans which are secured against good, you can see advance against goods. There should be goods as a security should be marketable, stable and non-perishable. Now if we compare hypothecation and pledge, so hypothecation is preferred for flexibility, and loans secured by goods use either hypothecation or pledging depending on the flexibility, and goods must be stable and non-perishable and their value is checked against the market price. Now let's talk about hypothecated goods and advance against warehouse receipt, these two topics. So you can see storage of pledged good. First thing is that when goods are pledged, a board at the entrance shows they are secured by bank. So you can see go down board displayed at the main entrance to third caution property. These goods must be insured for risk like fire or burglary in bank name, right? Insurance is must. The go down or the storage must be safe, leak proof and well maintained. Now there is something called hypothecated goods. See, borrower submit regular stock statement and if they don't submit, check may bounce, right? So obviously stock statement should be regularly submitted by the borrower, and bank officer inspect the stock monthly or quarterly to ensure everything is in order. This is crucial for keeping the loan secure, right? Now advance against warehouse receipt. Regular inspection check the goods condition and movement. Now once government issued receipt are accepted for loan, only government issued receipt are accepted for loan. Private one need bank approval, right? And only top quality goods can be used as security, right? And good grades, only grade 1 goods should be accepted as security, that is called top quality. The receipt must be in borrower name and endorsed to the bank. Now there is something called operational aspect of common loan product. Like common loan product include warehouse receipt advance. Two common loan types, one is warehouse receipt advance and educational loan. The first is warehouse receipt advance. These loans are secured by goods stored in warehouse with regular inspection to ensure the stock is safe, and verified signature from the borrower are kept on file for security. Now let's talk about education loan. These loans help a student cover cost for education in India and abroad. They are available to the Indian national, NRI, PIO, OCI student. A student must have been admitted to the recognized institution based on exam and merit. The loan cover tuition fee. The loan should cover besides tuition fee, it should cover books, travel and other necessary expense, right? No security is needed for loan up to 4 lakh. So if the loan amount is less than 4 lakh, no security is needed, but for higher amount a parent or guardian must co-sign. Remember this point, right? It includes tuition, exam, lab fee, equipment, travel, everything is included. Eligible courses like government subsidized course, shipping, nursing and other course, abroad job oriented professional technical course for undergraduate, these are eligible courses. And now what about the quantum of loan? So depends on repayment capacity and requires suitable margin. For up to 4 lakh no security required, above 4 lakh parent guardian as co-borrower. And now documentation. So for larger loan, scholarship and other financial assistance are considered. So documentation, both student and parent guardian must execute necessary loan document. And hypothecation of computer, if a computer is a part of loan, it is hypothecated. Loan sanction and disbursement, sanction under delegated authority, no loan rejection without higher management approval. Now education loan, further some points are regarding, you can see that approval based on authority, and any loan rejection must be reviewed by higher management. Funds are given in stages and paid directly to the institution or vendor, right? And the next thing is something called repayment. Students get a 1 year moratorium, 1 year break after their course, and then after they have 15 years to repay with flexible EMI. Now interest rate linked to the bank base rate with different rate for secured and unsecured loan. Interest during the study period is simple interest. During the study period the interest is simple interest, right? And then after we discuss insurance. A student must have life or accidental insurance for the loan. Progress tracking, that means the bank keep in touch with the college to track the student progress. For a student studying abroad, they must provide the ID and job detail. If we talk about processing charge, no upfront charge for education loan up to 7.5 lakh issued by a branch for a student intending to study abroad. If we talk about the vehicle loan, So you can see the vehicle loan cover new or used car, SUV and even two-wheeler. Eligibility individual, firm and company can apply. Documents applicant need to provide financial statement, income tax return, salary slip or invoice for the these are the required document. You can see salary slip, form 16. And if you talk about the maximum tenure for this vehicle loan, so you up to 84 months. Loan to value ratio for car pricing between 7 to 10 lakh, you can borrow up to 85% of the car price, and if the car pricing above 10 lakh, the loan limit is 80%. Now interest rate are set by the bank followed by RBI guideline. Interest is calculated daily on reducing balance basis with penalties for late payment, right? Now let's talk about the repayment structure. So repayment is usually fixed with monthly EMI and there is no penalty for paying off the loan early. Now loan security, the vehicle is hypothecated to the bank, which means it is marked in the registration certificate. Insurance requirement, that means you need comprehensive insurance for either the market value of the vehicle or 10% more than the outstanding amount. Fee and charges, processing fee charged upfront during the loan application process. Government tax, so bank may collect any applicable government tax related to the loan. KYC verification must be completed. This is very important. Now let's talk about the recovery agent. See, in when cases go to the recovery agent, borrower must be informed about the details. Call recording, all calls with customer are recorded and they are made aware of this. Transparency, that means bank might publish detail about recovery agency on their website. Complaint handling, that means bank need to resolve any complaint before involving recovery agent. Legal caution, care is taken to handle cases that are in legal dispute to avoid issue. Grievance mechanism, that means there should be a system to address borrower complaint effectively. Recovery agent are trained to manage their responsibility sensitively. Agent must hold IIBF debt recovery certificate. Then periodic review, the recovery process is regularly reviewed to improve effectiveness. And bank responsibility, bank are accountable for their agent action and must follow guideline. Now there is something called fair practice code. Bank and agent must not intimidate or harass borrower. Bank need to create their own fair practice code based on RBI guideline. Application form should clearly state fee, charges, prepayment penalties and conversion cost. Fee transparency, all relevant fee and charges must be clearly disclosed to the borrower. All in cost disclosure, bank must inform customer of the total cost for easy comparison. Now let's discuss the credit decision timeline. So transparency, bank must disclose how long it takes to make credit decision on their website. Application verification, loan application should be verified promptly, and if more information or document are needed, borrower should be informed quickly. Let's talk about the credit management. There is something called credit limit approval. When bank limit are approved, borrower must receive the information in writing, including the terms and condition. Now loan agreement documentation. All loan agreement must be formally documented and certified by the authorized official with a copy provided by the borrower. Now discretionary facility, any extra benefit or facility offered must be clearly mentioned in the loan agreement. Topic name is types of collateral and their characteristics. So let's begin. So first thing first, that what is credit risk, right? So credit risk is the chance that someone who borrow money from a bank might not pay it back. To reduce the risks, bank asks for asset like property as collateral to secure the loan, right? Now what makes good security? First thing, it should have a clear title. Good security need to have few key features which I am describing. It should have a clear title, meaning there are no legal issue. Second thing, it should be easy to identify and sell if needed. It should not have any liabilities or debt attached. Also, the owner should have absolute control over it. It must have a stable market value and be easy to store. Now let's talk about secured versus unsecured loan. There are two main types of loan. One is called secure, other is called unsecured. Secured loan means borrower gives the asset like property or bond as collateral, right? The bank hold these in case the borrower can't repay. And the second is called unsecured loan, means no asset are given and the bank trusts the borrower ability and integrity to repay. Now the question is, why secured loan? See, banks prefer secured loan because they have a backup if things goes wrong. If borrower struggle, and the bank can use the collateral to recover the money. Now let's talk about the types of security. See, banks accept different types of asset as security, like immovable asset, which includes land and building, like movable asset, which includes things like car and gold, like financial asset, which includes investment or receivable, right? And the last is intangible asset, which includes brand value and goodwill. So in short, credit risk is a big deal for bank and security helps them manage it. Whether it is secured or unsecured, the bank goal is to reduce risk and protect their money. Now, let's talk about bank can't sell the land and building if someone can't repay their loan. Thanks to bank can sell, not can't sell. Bank can sell the land and building if someone can't repay their loan. Thanks to the SARFAESI Act. The good news: land usually goes up in value, but it is not all easy. Valuing property can be tricky, and getting a clear title takes time and money. Right? That is the disadvantage. The good news is that land value increases over the time, and the bad news you already know. Now, agricultural land. Agricultural land is not as valuable as other type of property because of laws like land ceiling and debt relief. So these laws are in place. Because of this, agricultural land is not as valuable. It is also harder to sell quickly and may bring in less money. Plus the legal cost. Right, the legal cost like stamp duty, registration, you can see it written, stamp duty, registration adds to the expense. Now, what are the documents required from mortgager? So when using land as security, bank need a lot of document like title document, sale deed or gift deed. The next is parent document, that means the 30-year history of ownership. Next, encumbrance certificate, a 13-year check to ensure there are no debt. Tax receipt, proof that the property is in possession. Court permission needed if the land is owned by a minor. Search report, if it is company owned property, then search report is required. Lawyer's report to make sure the title is clear. Now let's talk about the valuation of the property. Before giving out a loan, bank need to know the value of the property. This is done by an approved engineer. The property value depends on things like construction type, location, tax. Right, construction type, building age, title, tax, whether it is freehold or leasehold, etc. Now let's talk about the security value perception. Finally, the value bank gives to the property as security depends on its own policy and how much risk they are willing to take. So land and building can make good security for loan, but there are a lot of steps involved in valuing and securing them. Right. Now let's talk about this ownership, which is freehold versus leasehold. When you own a property, it can either be a freehold or it can be leasehold. Freehold means you own the property and the lands it is on completely. Right. Freehold means you are owning the property and land also which it is on. And leasehold means what? Leasehold means you own the property but someone else own the land. You can use it for a set of number of years, but after that let the landowner take it back unless you renew the lease. Right, so that is called leasehold property. Now what is the advantage of goods as a security? Now let's talk about the goods. See, bank often use goods like stock or merchandise as security for the loan. Right, goods like stock and merchandise are used by bank as security. Right, these things are used as security for the loan. Here is why. What is the advantage of goods as security? Goods are usually easy to sell because there is a ready market, and goods valuation is simple. They are tangible, you can see and touch them. Loans are usually short term, right, which reduce the risk, and also it is cheap and easy to create a charge on good, especially when dealing with trustworthy customer. Now, what are the disadvantages? Goods can spoil or deteriorate. There is a risk of fraud or dishonesty. The value of goods can fluctuate, and it's sometimes hard to know its real value, and selling large amount quickly can be difficult, and there are also storage and transportation issues. Right. So now what are the precautions bank take? Bank takes several precautions when giving loan against goods. The first is, if the goods are pledged, bank hold the goods. So the first case is, suppose the goods are pledged. So bank, obviously in the case of pledge, bank holds possession. And if it is hypothecated, the borrower keeps possession. You know the difference between pledge and hypothecation, right? Okay. Now the second thing is that bank prefer goods that are non-perishable, in demand, and easy to price and manage. Loan are not given for risky activity like speculation or hoarding. Banks are also check the goods are fully paid for, stored securely, and now let's talk about the inspection and related aspect. See, very important concept. Bank need to regularly inspect the goods that borrower use as security for loan. Here is how they manage it. The first is called stock arrangement. Goods should be arranged so that they are easy to check, and any hazardous good need to be stored separately. Next thing is go down. So these are also called warehouses. So these should be secure and easily accessible for bank official. Regular inspection. Banks sometimes do surprise inspection to ensure everything is in order. It is important not to rely on the borrower vehicle for this visit. Next thing is stock audit. Verification means bank will count, weigh and check the stock and compare it with the borrower record, including purchase and sales data. The next is stock audit. For larger loan, bank perform a yearly stock audit to ensure everything is accounted for. Next thing is valuation. Goods are valued based on either cost or market price, whichever is lower, right? Non-moving stock, item that are not selling, is not included. Next thing is professional valuer. Experts like CA, engineer, stock valuer are sometimes hired to assess the goods. Now let's talk about the trust receipt. So trust receipt and the precaution bank take. First thing is title document versus acknowledgement. Sometimes documents like title deed can be pledged as security, but other like warehouse receipt cannot be transferred as security. Remember it, very very important. There is always the risk of fraud, false document or unpaid vendor issue that can make the bank security worthless. To reduce this risk, bank always verify the document authenticity of the document. Make sure the goods are insured. Get a copy of consignment paper in the bank's name. Now the question is, what is this trust receipt? A trust receipt is a document where the borrower hold the goods or proceed from the sales of goods in trust for the bank. Even if the borrower become insolvent, the bank can still claim the goods. The borrower sign a letter acknowledging that the bank has right over the goods and sale proceed, making sure that everything is properly insured and that the unsold goods are returned to the bank. So that is called trust receipt. It is a document where borrower holds the goods or proceed from the sales of the goods in trust for the bank. Right. Okay, so this is the important points related to the trust receipt. So to summarize, inspection and trust receipt help bank ensure that goods or used as security are safe and well managed. Now let's talk about advance against life insurance. So life insurance policy are considered good security for loan because they are regulated. First thing is they are regulated, which makes it easy for bank to claim them if needed. Bank can easily assign the policy to themselves. The longer the policy has been in place, the higher the surrender value. If the borrower passes away, the policy can be used to liquidate the loan. If the borrower default, the bank can quickly get their money by surrendering the policy. Now, disadvantage to watch out for. See, but there are also few things to keep in mind. If the borrower does not pay the premium, the policy can lapse, right? And reviving it is not easy. Next thing is, if the borrower misrepresent or does not disclose important information, the policy can become void. The policy holder must have an insurable interest, meaning they have to benefit from the insured person life. Otherwise, the policy won't be valid. Some policy have restrictive clause, which means they can limit how much the insurer will pay, right? So that is what you have to see also. Now there are some key consideration to be bank need to be careful when accepting life insurance policy as security. The policy must be assigned in the bank favor and be free from any other claim. The next thing is that policy must be original, currently in force, and all premium should be up to date. Some life insurance policy come with condition that may make them unsuitable for security. And once a policy is assigned to the bank, the nominee, means the person who would receive the benefit, is automatically cancelled. Right. So once a policy is assigned to the bank, the nominee is automatically cancelled. So in short, life insurance policy can be a great security for loan, but there are some key things to keep in mind, which we have just discussed. Now let's talk about advance against sale. So every aspect we are touching. See, advance against sale, bank offer loan using share as security, but there are some rules. The first rule is that only listed equity share are acceptable. Unlisted share are rarely allowed. Right, you know, some shares are listed on the stock exchange, only those are applicable. And share must be full paid and in a dematerialized form. The loan must be for productive purpose, right? It must be for productive purpose, not speculative. Now, what are the advantages of advance against share? The first is that using share as security has several benefits. First thing is that it is easy to figure out the value of the share. Value as ascertainment is quite easy. Share tend to be stable and provide intermittent income. And there is a minimum paperwork, and releasing the security is straightforward. But there are some disadvantages also. Share price can fluctuate, and there is a risk of fraud. Partly paid share are harder to sell and may have a restricted market. right? For partly paid share, they are restricted market. Now what are the precautions that banks should take? See, bank need to be careful while lending against share. They maintain an updated share list, regularly review the portfolio, and set limit on how much can be borrowed. They also take margin, which is for partly paid share, to reduce the risk. And one thing you must remember, bank can't hold more than 30% of their own or any company paid up share when it comes to share. Remember this, very important. RBI guidelines say all loan and investment in share must follow RBI guideline, which set a strict provision to protect bank. Now, what about the bank capital market exposure? Let's talk about how bank manage their exposure to the capital market. Bank directly invest in equity share, convertible bond, debenture, mutual fund, giving loan against share, bond or mutual fund. Bank can also have, this is how direct exposure. And indirect exposure means giving advance against share, bond, debenture, equity, mutual fund, offering loan for investment in share, bond, mutual fund, or giving loan secured by share, bond, where primary security does not fully cover the advance. Means the primary security is not enough to cover the loan fully. So in summary, bank offer loan against share, but they follow a strict rule, right? Now let's talk about the stock broker exposure. And so bank often give loan to a stock broker, either secured or unsecured, to help them with their trading activity. They may also provide guarantee for a stock broker or market maker. Additionally, bank can give loan to companies for the promoter's equity contribution. You can see written promoter security contribution when starting new business. So these also count as a part of bank's capital market exposure. Bank must follow a strict rule when it comes to capital market exposure. This include financing a stock broker for margin trading and exposure to VC, a venture capital fund. Bank total capital market exposure, which includes both fund and non-fund, must not exceed 40% of the bank net worth. And the direct exposure to share, bond or mutual fund must not goes over 20% of the net worth. Remember these two are very important. Total capital market exposure not should exceed 40%, and direct exposure should not exceed 20%. Banks also need to manage their consolidated exposure, right? Banks should manage their consolidated exposure, meaning the total of their capital market related loans. These two must not exceed 40% of the net worth, with direct exposure capped at 20%. For advance, bank has to ensure loan are for legitimate purpose only and are valued at market price. No loan are given for acquiring a controlling interest in the company. Bank can't give loan against partly paid share or to partnership firm where the shares are used as a primary security. Now, so these are the important thing to keep in mind. Already I have told you consolidated exposure, already we have discussed in the previous slide. Now, advance against share, bond, debenture to individual, very important. When it's come to individual, bank follow this guideline. The board of director sets the rule for sanctioning such loan. Indian bank cannot provide backing for overseas loan if the Indian client is investing in Indian share or bond. There is 50% margin requirement for loan against share and IPO financing. For capital market guarantees, the bank need to maintain a 25% cash margin as a part of 50%. Now let's talk about the temporary overdraft, OD. So banks sometimes offer temporary overdraft to help with short-term financing need. The same margin rule applies if the stock broker are using overdraft for finance. What is the purpose of overdraft? It is used to cover contingencies, personal need, or to buy new share either through right issue or through secondary market. Loan limit, so up to 10 lakh if you are dealing with physical security, and up to 20 lakh for dematerialized share. Now let's move on to the loan against share for individual. So these loans are meant for genuine investor, not for stock broking or group loan, back to back specific loan. Loan policy, bank follow RBI guideline. Margin requirement, for remember, for physical share debenture 50% margin is required. For dematerialized share debenture 25% margin is required. Bank may set high margin if needed, especially for preference share or non-convertible debenture. Individual can borrow up to 10 lakh, maximum 10 lakh when subscribing to IPO. Now bank can also issue guarantee to a stock or commodity broker for their exchange margin requirement, right? But there are some safeguards to protect both bank and borrower. Bank assess the borrower actual need, set exposure limit, and establish sub-ceiling for loan and stock broker. Loan are not provided for arbitrage operation. Remember it. When I say arbitrage means when a broker try to profit from price difference between market. For that, no loan is provided. Next topic we have to discuss is bank finance for market maker and margin trading. Margin trading is when a stock broker borrow fund to trade, and it is restricted by the 40%. Just move to here. So you can see that it is restricted by the 40%. capital market exposure limit. Bank required a 50% margin on the fund lent for margin trading, and the share must be in dematerialized form and placed to the lending bank. Second thing is monitoring and safeguard. See, bank must constantly monitor that the 50% margin is maintained. Additionally, bank board need to ensure that there is no improper relationship or nexus between the bank and stockbroker when handling margin trading. Now let's talk about advance against unit of mutual fund and debenture. So for mutual fund, the unit must be listed or have a repurchase ability. They should have completed their lock-in period, and the loan is linked to the NAV, that is net asset value or market value. For debenture, they are not considered as a primary security for corporate loan, but can be accepted as collateral for secured loan. The promoter share used as a collateral must be in dematerialized form. Bank can accept debenture as collateral for temporary margin arrangement if the borrower is short of fund. Now, what is the bank policy and corporate loans? So bank need a detailed loan policy for a stockbroker and market maker covering loan purpose, collateral, exposure limit. Remember, for collateral loan there is a limit. Any advance provided for promoter contribution is treated as bank investment in share, which also fall under 40% exposure limit. Right. So obviously bank plays a crucial role in market finance. Able to grasp all the important concept. The topic name is different mode of charging security. The first topic is essential of contract. Let's start with essential of contract. You know, bank give out loan using property or debt as security. How you handle the property depends on the property type. Following laws like Indian Contract Act 1872 and Transfer of Property Act 1982. For businesses, the charges on property must be registered under acts like Companies Act, Registration Act and SARFAESI Act. Right. The contract is basically an agreement that can be enforced by law. But for it to be valid, both parties need to agree freely, and there must be something of value exchange. Now, key elements of contract include proposal, or we can say offer, acceptance, or you can say acceptance of that proposal, consideration, which means both parties are getting something in return, and something we call contract can be verbal or contract can be written but needs to be officially registered. Right. So this is what contract. Now let's talk about the consideration and consent in contract. Consideration is the value exchange between the parties. It can be something that happened in the past, or is happening now, or will happen in the future. Now there are few exceptions where no exchange is required, like in the case of nature love, like in the case of voluntary act or compensation. Now the object of the contract must be lawful. What does it mean? So it means it can't involve anything illegal or against public policy. Next thing is free consent, that no one was forced or tricked into agreeing. If someone was pressurized or misled, the contract can be cancelled. Finally, let's look at the contract of agencies and banking. For any contract to be valid, both parties must be legally competent. For example, contract with minor are automatically considered invalid because they are not competent. In banking, the bank act like a debtor. Remember it, this is the debtor-creditor relationship, because in banking, bank act like a debtor. Customer, when you deposit money, see, you deposit money, right? So in this case, since you have deposited money, so bank act like a debtor and you act like a creditor. And when it's hold so when bank hold your money, then it acts like a trustee, and an agent, bank act like an agent when it's handle remittance for you. So you can see there are different kind of relationship. Either it can be debtor creditor, trustee bailer for securities, and agent principal. Now you know what is agent? Agent is someone who act on the behalf of another person, called the principal. Agent act on the behalf of principal. So the agent authority can be given directly, indirectly, or in case of emergencies. So that is about basics of contract in banking. Now let's move on to the next slide. Now so friends, let's start with del credere agent. What is this del credere agent given in your book? See, this is a special type of agent like a broker, right, who guarantee that the buyer will pay up. If the buyer does not, the agent is responsible for covering the loss, right? So this particular agent is possible, that is act like a broker, right? And he will cover the loss if buyer does not pay up. If agent does something without permission but the principal accept the benefit, it is called ratification. So ratification is implied. Suppose agent does something without permission and but the principal accept it, right? So in that case this is called ratification. Now if we talk about the termination of agency, can happen in many ways, like if the task is completed, the agent or principal revoke an agreement, or in the case of death or insolvency, right? So this particular agent agency is terminated. Now let's talk about agent's duty and remuneration. An agent must follow the principal instruction, cover any loss, like in the case of, I've just told you, agent principal relationship. In the case of your remittance, like the bank is remitting on your behalf, so bank is acting like an agent and you are the principal, right? So already we have covered what is this del credere agent, broker who extend credit to the buyer, and liable if buyer default. Okay, ratification we have discussed, like if principal accept benefit from an agent unauthorized act. Termination we have discussed. Now what is the duty of agent? Agent must follow the principal instruction, cover any loss, and provide a full account of what they did. They must not act in their own interest. Next thing is remuneration or payment is only due once the task is completed. If an agent misbehave, they lose their right to the payment, but the principal must cover the cost of the agent legal action, right? So this is very important. Now let's discuss contract of bailment. So what we have discussed in the previous slide, we have discussed the agent's duty, we have discussed the contract of agencies and banking. Now we are switching over to contract of bailment. Bailment means handling our goods for a specific region, and the goods must be returned afterward as directed in section number 148. For bailment to work, possession of the goods is the key. Possession is the key, as you can see written here. Possession is the key. The bailer means whom? Bailer means giver. Means giver, right? The bailer must also let the bailee means holder, right? The bailer must also let the holder, that is bailee, know any kind of defect. So disclosure of defect is must. Both the bailer and bailee have responsibility. The bailer is liable for the hidden defect, and while the bailee must not misuse the goods, right? Bailer for undisclosed, bailee for misuse, bailment void if terms are violated, right? Now let's discuss the bailee duty, and bailer's right. So bailee must return the goods. Bailee must return the good once the purpose is fulfilled. If they delay or cause damage, they are responsible. Already I have told you in bailment, bailee returns the good, right? Now what about the bailer's right? Bailer has a right to expect the goods back and can hold the bailee accountable if they misuse them. The bailee can hold on to goods until payment is made if needed. That is a quick overview of agencies and bailment. Now let's switch over to types of charges. See, the first is called mortgage. What is mortgage? Mortgage is a legal claim on immovable property, right? Like house, like a land or a house. It is used as security for the loan. Second is called lien. You know what is lien? Lien gives the bank the right to keep your goods until you repay your debt. Right to retain goods until the debt is repaid, right? So lien gives the bank the right to keep your goods until you repay your debt. Next is what is called set off. What is the meaning of set off? Set off means bank can offset or balance out debt you owe them against the debt they owe you. Means bank is offsetting or balance out debt you owe them against the debt they owe you. Next is assignment. Assignment is when someone transfer their right, like claims, to the bank. Next is called hypothecation. Hypothecation means movable property like vehicle is used as security without handling over possession. Next is called pledge. It is similar to hypothecation, but here the bank take possession of the movable good. In the hypothecation, possession is not handed over to the bank. Appropriation is when payment is applied to a specific debt. Now let's talk about assignment or assignable claim in the next slide. See, an assignment of claim must be written and signed. It must be signed by the transferor. So after assignment, the new holder can sue in their name and takes on both the right and responsibility of the original holder. Now let's move on to the priority of the crown debt. So government debt get top priority and must be settled first as per the law. So government debt get top priority and it must be settled as per the law. Government debt must be settled first as per the law. Now if we talk about the set off and its silent feature, set off means if you owe the bank money and they owe you, these debt can cancel out against each other. So if you owe the bank money and they owe you so these debt can cancel. What are the key features of set off? The first is mutual debt. Both parties must owe each other clear amount, right? So mutual debt is applied when both party owe each other different amount. Mutual capacity, the debt must be between same people in same capacity. Demand, you can only set off debt after a demand is made or the debt is due. Set off after demand is made, debt or debt is due. Next is called exclusion. So what is the meaning of exclusion? You can't use set off for guarantor account or any uncertain liability. So no set off for guarantor account or contingent liability. Partnership, a partner's account can be used to offset partnership debt. Sole proprietorship, personal and business account can set off against each other. Insolvency, in case of insolvency or death, the bank automatically has a right to set off. Garnishee order, the garnishee order allow bank to set off debt against a court order. So that wrap up our quick look at the type of charges and the set off feature in the banking. Remember, the case study are asked from all these things. Like in the case of partnership, sole proprietorship, insolvency, death, garnishee order. Friend, if you really think that such type of content is helpful to you, please hit the like button. This will motivate me to make some more such as content which will enable you to revise the entire content in a short period of time. Now let's talk about the assignment. Assignment means legally transferring property or right to another person or party. Now that is the meaning of assignment. You are legally transferring the right or property to another person. Now first thing is for legal assignment. Yes, so for a legal assignment it must be in writing, written clear, it must be writing, and the person who owes the debt must be notified. So debtor should be not notified. So it must be legal, it must be writing, and the debtor must be notified. And now for the case of life insurance, in the life insurance you can assign your policy by endorsement or deed, right? But the insurer must be informed, that whoever has given the insurance, he must be informed regarding this. Now what is the effect? Once assigned, the new owner, that is assignee, gets all the right, including the right to sue if needed. Now next we have lien. You know what is the lien? Lien is the bank right to hold on to your goods and security until you pay your debt. So until unless you pay your debt, banks have the right to retain goods and security. The banker's lien is a legal claim, is a legal right that does not need a special agreement. Right, it is implied by the law, no special contract needed. Applicability, this applies to goods or security given to the bank as a part of regular banking business. Negative lien, negative lien is when the borrower promise not to use their asset as security for other loan without the bank permission. Right, so when the borrower promise not to use their asset as security for other loan without the bank permission. Now finally, let's explain hypothecation. Hypothecation means using movable property as security for loan while keeping possession of the property. So it is governed by the SARFAESI Act, which allow bank to recover their money in the case of default, like in the case of car. Now the borrower keeps the goods and there is no transfer of possession. If the borrower default, the floating charge become fixed. That is called crystallization. When I say crystallization, it means floating charge become fixed. Now what is the difference? See, if we talk about the mortgage deals with immovable property. Pledge involve transferring possession to the bank, but in hypothecation, borrower keeps the good. So in the case of pledge, we are possession for transfer of possessions, like in the case of gold loan. Hypothecation is often used for things like inventory or goods still being worked on. Now what are the challenges? The bank has less control over the goods and their value might decrease, making recovery harder. Now that's a quick rundown on assignment, lien and hypothecation. If this was helpful, make sure to like and subscribe for more easy explanation on all the topics. Now let's start with precaution for bank. So bank need to ensure all legal documents for hypothecation are properly signed and executed. Inspection are crucial. Regularly checking the goods help reduce the risk of fraud. If the borrower default, the bank must take timely legal action to recover the loan. Next is the deed of hypothecation. See, the borrower must not hypothecate the goods to anyone else without the bank consent. Next is good labeling. The goods must be labeled to show they are hypothecated, preventing any claim from third party. So goods labeling is must. Next is registration. The bank must register the charge with the ROC, registrar of company, within 30 to 60 days. Otherwise the charge become void. Right, so charge must be registered with ROC within 30 to 60 days. This registration is very important. Next is borrower also need to submit regular stock statement with detail about the goods, like their quantity and the value. Right. Now let's talk about the trust receipt and pledge. Trust receipt means borrower hold the goods or proceed in trust for the bank, acting as a caretaker. right? So now valid pledge can be created by the owner, an agent, or the seller in possession of the goods after a sale. In some cases, the lender, that is called pawnee, can replace the goods to another party, but only upon their interest. Even if a second lender holds the goods, the borrower, that is the pawner, still has a right to get them back after repaying the debt. Now, what are the right of pawnee? So obviously, in the case of pledge, there is a word called pawner and pawnee. So pawnee can replace the goods upon their interest. Pawner entitled to the goods even if it is held by second pawnee. Now, if we talk about the pawnee's right, sorry friends. So the pawnee has a right to retain the goods until the debt, interest, and necessary cost are paid. So can hold the goods for debt, interest, and preservation cost. However, pawnee can't claim extra expense beyond preservation cost. So he can retain the goods, he can hold the goods for debt, interest, and preservation cost, but he can't claim the extra expense. The pawnee can sue to recover the debt of the goods, but they can only hold the goods for the pledged debt. If a third party wrongfully takes or damages the goods, the pawnee can sue them. Right? We are talking about debt repayment. The lender is called pawnee, remember, and the bank is called pawner, obviously. So the borrower is called pawner. The lender, in the case bank, is the lender, and the second lender hold the goods. The borrower, that is the pawner, has a right to get them back after repaying the debt. So it can get the back. Borrower can get them back after repaying the debt. And if the borrower default, the pawnee has a right to sell the goods. So bank here is pawnee, right? So cannot claim for pawnee right is he cannot claim for extraordinary expense. He can sue to recover goods, can sue for wrongfully deprivation of or injury, and he can sell goods if the pawner default. If proceed exceed debt, surplus goes to the pawner, right? Now, what are the duties of the pawner? Let's discuss in the next slide. See, a pledge makes you give your goods to the bank as security for the loan, right? So the pawner, that is the pawnee, that is the bank, can retain or sell the goods if you don't repay the debt, but they must give you notice before selling. As the pawner, you have the right to redeem, that means get back your good before they are sold, and if the goods sell for more than your debt, you get the extra money. Liabilities: if the sale does not cover the full debt, you are responsible for paying the difference. You also need to inform the bank of any defect or risk of the goods. You must reimburse the bank for any preservation cost they incur. Most importantly, you must own the goods you pledge. Now, let's discuss the difference between pledge versus lien. In a pledge, if you don't pay the debt, the bank can sell the goods. In the case of lien, lien can allow the bank to keep your goods until the debt is paid, but the bank can't sell them unless it is a general lien. Remember it. Unless it is a general lien, right? The bank can't sell them. They also inspect your goods and record. Now, if you don't insure the goods, the bank can insure them for you. You as the pawner are responsible for paying rent or charges, but you are not liable if the broker default. Pledge advantage: the advantage of pledge is that it is allowed for easy sale, supervision of the goods, and insurance. Bank need to take precaution by verifying ownership and conducting regular inspection. Next, we have mortgages. See, mortgages, in a simple mortgage, you promise to repay the loan, right? There are different kind of mortgages. We will discuss simple mortgage. In simple mortgage, you promise to repay the loan, and if you fail, the bank can sell your property to recover the debt. Unlike pledge, there is no transfer of possession, meaning you keep your property while repaying the loan. If the sale does not cover the loan, you are still liable for the shortfall. The bank, that is the mortgagee, needs to go to the court to sell the property, and they don't have any right to the property income. Registration is required for loan is 100 or more. Obviously, registration is required, right? So this is the point. Now there is something called simple mortgage. Mortgage by conditional sale. Here the property is sold with the condition that if you repay the loan, the sale is reversed. But if you fail to repay, the sale becomes final and the bank keeps the property. Next is general mortgage info. See, a mortgage transfer interest in the immovable property to secure the loan. It can be created by property owner, co-owner, family head, HUF karta, guardian, or executor. Right. Now, we have already covered what is simple mortgage. Right. Simple mortgage means you pledge your property as a security for the loan. You keep both ownership and possession of the property. But if you can't repay the loan, the bank can sell it to recover the money. There is something called mortgage by conditional sale. So you sell your property with the condition that if you repay the loan, the sale is cancelled, right? But if you fail to repay, the sale becomes final. That is called mortgage by conditional sale. Next is usufructuary mortgage. Remember, case study is asked. The bank take possession of your property and collect rent or profit from it. The earnings are used to pay. These earnings are used to pay off the interest or reduce the loan amount. So the position is not in your hand in the case of usufructuary mortgage, rather the position is in the case of bank, and collect rent or profit from it. Next is mortgage by deposit of title deed. You don't need to sign any deed, you just deposit the property title document with the bank, that creates security for the loan, right? The next is English mortgage. English mortgage, in this type the bank take ownership of the property, right? So the banks take ownership of the property, and while you repay the loan, the ownership returns to you when you repay the loan. Next is anomalous mortgage. So this is a mix of different type of mortgage and does not fit neatly into one category. Let's dive into mortgage by conditional sale. You sell your property with a promise to repay the loan. If you repay it, the sale is cancelled and you get your property back. If you don't repay it, the sale become final and you are personally liable for the loan. You are not personally liable for loan anymore. The bank can foreclose on the property but can't sell. Now let's talk about usufructuary mortgage. Let's discuss little bit more, right? So usufructuary mortgage, in this type of mortgage, the bank take possession of your property and use the rent or profit to either pay the interest or to reduce your loan. However, if the deeds allow, you may keep possession of the property, right? Now let's discuss little bit about equitable mortgage, or it is called mortgage by deposits of title deed. So essential to create this type of mortgage, three things are needed. First thing is debt you owe to the bank, deposit of the property title deed, and you intend to use those deeds as security for the loan. The best part, there is no need for mortgage deed or any registration. It is simpler and faster. Procedure: first a title clearance is done, which include a search of the land record. Then you deposit your original title deed with the bank as security. Now what are the merits? That it save on registration costs, since no deed or registration is required. Formalities is less, making it quicker and more private compared to legal mortgage. But there are some demerits, that if you default, the bank has to go through a costly and time consuming legal process to sell the property and recover the loan. Key points to remember: equitable mortgage takes priority over any later mortgage on the same property. So bank with your original title deed has the first claim. Remember it, very important thing. Now let's look at the anomalous mortgage. So anomalous mortgage, it is a combination of various kind of mortgage. Now position in mortgage. In some mortgage like usufructuary and conditional sale, the bank get possession of your property. In simple or deposit title deed mortgage, the bank can claim the property or sue you if you don't repay. Lastly, there the rule of priority. Remember this rule, very important. So it follows the principle first in time, better in title, meaning the first mortgage created has the highest priority. If they are registered document, priority is based on execution date, not the registration date. There is some exception to the priority rule. Let me discuss this also. Normally the first mortgage created takes priority, but under section 50 of the Registration Act, a registered mortgage can overwrite an unregistered one. So however, if the bank already hold the title deed, the mortgage takes priority over any lateral registered one. Now let's talk about civil suit for recovery. That is, loan is supposed less than 20 lakh. So if you need to file the suit in the court when the mortgage property is located, all subsequent mortgages, those who hold mortgages after the first one, should be included as defendant in this case. You must sue for all debt together until the court give permission for separate suit. Keep in mind the personal covenant, that is your agreement to repay, must be within the limitation period for enforceable. Let's move on to the mortgage decree. Mortgage decree is a court order that consists of two stages. The first called preliminary, second is called final. The preliminary decree lays out the terms for the repayment, and final decree allow the sale of the property if repayment does not happen. Now let's quickly touch on the leases. See, lease is when the right to use and enjoy a property is transferred, but the ownership remains with the original owner. There are two parties in the lease, the lessor and lessee. Lessor is the person transferring the right, and lessee is the person receiving those rights. There is a difference between lease and sale. Sale means complete transfer of ownership. Lease means only transfer some right, like use the right to use the property. Types of lease: agriculture, manufacturing for purpose. Lease are usually year to year or 6 month notice. For other purpose, terminable with 15-day notice. If the lease exceed 1 year, it must be registered instrument or an oral agreement where the lessee take possession of the property. If you want to mortgage leasehold right, the lease must be stamped and registered to valid. Documents are so important in lending, right? The documents plays a very important role in lending. So these documents are used to identify the borrower, confirm the loan address and loan details, then after ensure repayment and even help in legal recovery. But if the document are not filled out properly, they can become invalid. Now the types of document, there are few main types of document. The first is called DPN. DPN stands for demand promissory note. It means that the borrower promises to repay the loan whenever asked, and the interest is charged as per the agreement under the Negotiable Instrument Act section number 4. Next we have agreement. These agreements cover the loan amount, interest, security. They need to be stamped as per the Indian law to be valid. Some common agreement include pledge, hypothecation, term or clear loan and guarantee. It is important these are signed with proper stamp. Lastly, there are some forms. These shows the borrower intent but are not a formal promise or agreement like the other. So always ensure your loan document are properly filled and stamped to avoid issues later. Now let's talk about the documentation procedures. So first, the type of document you need will depend on the borrower and the facilities they are getting, and stamping is must. According to the Indian Stamp Act, all document needs to be stamped, but the rule are different if the document are signed inside India or outside India. Plus, stamp duty varies state-wise. If the document is not stamped, there is a penalty. When it comes to filing and execution, filing and signing, everything should be clear. The signature should be consistent with no confusion, and two bank officials need to witness the signing. And if there are any changes later, make sure to follow legal procedure. All changes need full signature, and remember there is a time limit for the legal action under the Limitation Act of 1963. So please go through this time limit, very important from examination point of view. You know about this limitation period? So limitation period for a loan can be extended if there is a part payment or the acknowledgement of the debt. Otherwise, fresh documents are required. Now, when it comes to the renewal of the document, you can either create new one or add deeds, but avoid cancelling the original one to keep the loan secure. Now, if the debt become time barred, so what does it mean? It means that the time limit has passed. So you need a fresh promise from the borrower to start a new cause of action. Now safekeeping. Safekeeping of loan document is also very crucial. This must be securely stored under an official custody in fireproof cabinet to ensure accountability. Then comes incumbency charges. So when there is an incumbency charge, suppose there is a new officer who takes up, right? So new officer who take over, so proper handling of document is necessary. The document should be preserved until the loan is fully recovered. Till that point, document should be preserved. That is called incumbency charge, right? So proper document handover is required and preserved until dues are recovered. Remember this. Now let's talk about the error-free documentation. So to wrap things up, let's talk about error-free documentation. For loan document to be valid, there must be accurate. It must be stamped on time and follow the legal rules. Document storage is centralized at hubs and should be kept safe until the full recovery of the due. Now let's discuss the RBI prudential norm. This was till unit number 28. Now let's move on to unit number 29. So RBI prudential norm, these are the rules which cover how bank recognize income, how they classify asset, and how they set provision based on how well the loan is performing. There is something called NPA definition. What is NPA? NPA means non-performing asset. So it is a loan where no income has been received for over 90 days. Payment are overdue and or the loan is not performing, right? So that is called NPA. Now for out of order account, there is some type of account which is called out of order. So this out of order account happen if the loan exceed its limit for 90 days and there are no credit for 90 days, or the credit are not enough to cover the interest. So this is called out of order account. So what is NPA? NPA is such type of loan where no income has been received for over 90 days, payment are overdue, or the loan is not performing. And out of order means if the loan exceeded limit for 90 days, there are no credit for 90 days, or insufficient credit for interest. Now let's talk about the income recognition. So in lending, income is only recognized based on actual recovery, right? Not on NPA until the money is actually received. When it comes to NPA interest, no interest is charged on NPA. Any unpaid interest or fees need to be reversed or accounted for. Interest realization should only come from genuine recovery, not from fresh loan or credit. NPA reporting. Every year on March 31st, bank must submit an NPA report for their global portfolio. Lastly, advance include both a standard asset as well as gross NPA, which gives a full picture of the bank loan performance. As you can see, gross advance is equal to a standard asset plus gross NPA. Now if we talk about the net advance, this is calculated by taking gross advance and subtracting the deduction, that is NPA provision, pending claim, part payment, interest capitalization, floating provision, right? Then we have NPA ratio. If we calculate gross NPA percentage, it is a ratio of gross NPA upon gross advantage, and net NPA percentage is equal to net NPA upon net advances multiplied by 100 to convert into percentage. And you know, gross NPA, it includes principal dues and funded interest term loan, that is called FITL, right? So lastly, bank need to review credit limit within 3 months. If there is a delay of about 6 months, the loan become an NPA. However, if the borrower pay off arrear, the loan can be upgraded. If the borrower pay off the arrear. Now let's talk about NPA handling. So how NPA are handled? If a loan become an NPA, remember all related facilities and securities are also considered NPA. However, bills under letter of credit might not become NPA even if other account are NPA. For derivative, if the payment are overdue by more than 90 days, they are treated as NPA. Eroded and fraudulent securities turned into doubtful and loss asset. For agriculture loan, it is called NPA. They become NPA if they are overdue for 2 short or 1 long crop season. A staff housing loan become NPA if payment are overdue on due date. Relief for agriculture borrower. So there is a relief for agriculture borrower. Short-term loan can be restructured if there is a calamity. Now project norms. Finally, project norm can also affect asset classification if there are changes in the repayment schedule or deferment in DCCO. This can impact how the asset is classified. Okay, so project, in so far as project is concerned, repayment schedule changes and DCCO deferment, it can impact asset classification. Now let's move on to the asset in income recognition. So income recognition for different type of asset. So first is for a standard asset, right? For a standard asset, income is recognized on accrual basis, meaning it is recorded as it is earned. So when I say accrual basis, it means it is recorded when it is earned. For substandard asset, income is recognized on cash basis. It means it is recognized on cash basis only when the actual it is received. So remember, this is very important, recognition of income. Now when it comes to Exim Bank, they also offer post shipment credit covered by ECGC under a guarantee refinance program, right? So the Exim Bank offer post shipment credit covered by ECGC under a guarantee refinance program which help exporter. For PPP exporter, what is PPP exporter? Public private partnership exporter. Debts are secured if the repayment is guaranteed by the authority as per the concessional agreement. Bank also need to separately disclose any loan that are backed by intangible collateral. Now let's talk about the NPA provisional guidelines. See, let's talk about NPA provisional guidelines. Different loans have different provisioning requirement. As you can see, farm credit, housing and SME, it required 0.25% NPA provisioning. Then CRE, commercial real estate, it is 1%. CRE residential, it is 0.75%. For teaser rate housing, it is 2%, which is reduces to 0.4% in 1 year. Now loan restructured due to natural calamity need 5% provision, and for other loan including medium enterprise, it is 0.40%. Now keep in mind, standard asset provisioning are excluded from the NPA calculation. Remember it, standard asset provisioning are excluded from the NPA calculation. There is also extra provisioning for loan with unhedged foreign currency risk. Now lastly, EBID, earning before interest and depreciation, which is used in the debt service coverage ratio, that is DSCR, is calculated as. So see how EBID is calculated. It is profit after tax plus depreciation plus interest on debt plus lease rental. Now let's talk about the floating provision. So till now we have seen the NPA provision, and let's move on to the floating provision, what it is all about. So friends, floating provision and additional provision, these two things we will look at. So first, floating provision are like extra saving that the bank keep aside. So what is this floating provision? So these are extra saving, right? These are extra saving that bank keep aside for their loan or investment, but they can only use this in really serious situation, and even then only if the bank board or the RBI says so. So you can see clearly written, it is created for advanced investment, need board policy, only used for extraordinary situation, right? These provision can't be used for regular bad loan provision and won't show up in profit or loss. However, they help reduce the value of the bad loan or even count toward the bank extra capital, right? So this is the advantage. Now for additional provisioning, you can see the additional, and this can be netted from NPR counted as tier 2 capital. Remember it can be counted as tier 2 capital. Okay, so we are talking about floating provision up to 1.25% of the RWA. Remember, they can be counted as tier 2 capital. Tier 2 capital is also called goal concern capital, right? You know it very well. They are also called goal concern capital. Now for additional provisioning, bank can make extra provision for bad loan in sector that are at more risk. Specifically, when it comes to lease asset, bank need to set aside 15% for the loan amount that has not been paid yet, right? And if the asset is unsecured, you can see if the asset is unsecured, they add an extra 10% on the top of that. It is all about bank keep prepared for unexpected financial bumps, right? Now let's see about doubtful asset. So if we talk about the doubtful advance, doubtful lease asset, and some other key point. For doubtful lease asset, if there is no security backing the loan, bank must made 100% provisioning. So 100% provisioning in case of doubtful lease asset, right? And second thing is that if the asset is secured, right? If the asset is secured, in that case, the amount bank set aside will depend on the value of security. So how much security is there, on basis of that the value it decided, right? Next we have the concept of write-off. See, if the loan is completely written off, it is taken off the book, or bank made 100% provisioning for it. It means that bank has set aside the full amount for the loss, but keep it in their record. For advance against deposit or instrument, the amount of provision a bank need to make depends on how the asset is classified, whether it is a bad loan or not. Lastly, we have interest suspense account. This account is used to track interest that is not received. Before bank calculate how much they need to set aside for bad loan, they deduct this interest from the loan balance. But remember, it is not counted as a provision. In short, these rules help bank stay cautious with their money and protect themselves from the loss. Now let's talk about doubtful advance under ECGC guarantee. Very, very important. See, the ECGC is an insurance company that protect bank when loan go bad. If bank has a loan covered by this guarantee, they only need to make provision for the amount that exceed the guarantee. This is the basic point, remember it, right? That exceeding the guarantee, they have to make provision. After factoring in any security they can recover. Now, high NPA provision, bank can set aside more money than required for bad loan if they do this consistently. This help reduce the overall bad loan on their book. For substandard lease asset, bank must set aside 15% of their loan amount plus any unpaid interest, and if the asset is unsecured, then extra 10% provisioning. And finally, for doubtful lease asset, bank need to set aside 100% of the loan amount if it is unsecured, and for secured asset, the provisioning depend on how long the loan has been doubtful. Remember, these are very important point, right? So these measures help bank stay prepared and minimize their risk from bad loans. Now let's talk about CGT MSE. See, let's talk about some important guarantees and provisioning related to loans. First of all, for loan covered under CGT MSE and CRG FT LIH guarantee. So bank don't need to set aside money for the portion of bad loan covered by this guarantee. Already I have told you in the case of ECGC also, right? They only make provision for the part that is not guaranteed. When it comes to foreign currency loan, if the Indian rupees loses value, it increases the amount overdue on this loan, meaning bank need to set aside more provision, right? Suppose rupee depreciate and it increases, then required provisioning, right? And if they lose money from revaluation loss in, if they lose money from revaluation, it is recorded as loss in their profit and loss statement, but any gain can be used to make provisioning. Finally, for country risk provision, bank need to set aside money for loan given to foreign country with the amount ranging from 0.25% to 100% depending on the risk. However, no provisioning is needed for the loan in the bank home country, right? That is called country risk. You know country risk, already you know about it. Okay. Now let's wrap up with few more banking provision for loan as foreign branches. You can see, for loan as foreign branches, bank need to make provision, but short term loan get lower provision compared to longer one. And now let's move on to the other provision. If a bank has provided liquidity for a loan that has been overdue for more than 90 days, right? Remember, bank has provided liquidity for the loan that has been overdue for more than 90 days, they have to fully provision for it. Remember it, that is called securitization liquidity. Next, for teaser loan, these loans with low interest rate initially, bank need to set aside 2% as the provisioning, which drop to 0.40% after a year. We already know about it, right? And you know, bank also need to set aside 3% more if the borrower goes over the lending limit. Lastly, there is something called PCR, provisioning coverage ratio, see, which is the measure of how much a bank has set aside for bad loan as compared to its total bad loan. So a 70% ratio is advised, meaning 70% of the bad loans should have provision. Any extra can be kept as buffer for future losses, but this need RBI approval. All these measures help bank stay cautious and prepare for potential risk. Remember, this PCR full question is asked sometimes regarding PCR. Now, writing of NPA, let's talk about it. So let's dive into writing of NPA and the process for resolution plan. When a bank write off a bad loan, any interest earned on the loan is taxable when the bank receive it, but the provisions set aside for this bad loan are non-tax deductible. Remember it, interest on the bad taxable are taxable, while the NPA provisioning non-deductible. So, but the provision set aside, yes, for resolution plan, you know, this is called RP. If a borrower over 5 crore or more, the bank must report it to CRILC, a credit reporting system, and start a resolution plan before the borrower default, right? If the default happen, bank need to review the account within 30 days. When the bank work together on a resolution plan, at least 75% of the total loan value and 60% of the lender needs to agree on the plan. If some lender does not agree, the plan must still offer them at least the liquidation value of the loan. The resolution plan has to be finalized and put into action within 180 days after the account review. These steps ensure that a smooth process for handling troubled loan. You know, resolution plan is related to trouble. That is called ICA, Inter-Creditor Agreement. Now, let's talk about this resolution plan, how it is implemented. See, there are few ways to implement the resolution plan. The first is account can be regularized, meaning the borrower start paying again. The loan can be sold to other party, or the loan term can be restructured, right? So for larger loan of 100 crore or more, special conditions are applied. Now, when it comes to implementing a resolution plan, an independent credit evaluation, that is called ICE, is required if the plan involve restructuring, especially restructuring the loan or changing ownership, especially for the case of 100 crore or more. The resolution plan is considered implemented once all the lender conditions are met or if the loan is fully settled. This process ensures that large loans are handled with care and the bank's interests are protected. Now let's talk about the delayed implementation. See, let's go over what happened with the delayed implementation of a resolution plan. If the resolution plan, in short it is called RP, is not implemented on time, bank must set aside extra provision. If they don't comply, the RBI may take supervisory action against them. There are some exemptions, right? Small businesses or MSME and entities covered under a special RBI insolvency rule are excluded from this requirement. For prudential norms on restructuring, if a borrower is struggling financially, right, the bank can offer some relief or concession, but this must be backed by a board approved policy. Finally, when an account is restructured, it is first downgraded to NPA, that is bad loan. A specific rule dictate how it can upgrade again if the borrower start making regular payment. Now let's talk about the additional finance in the next slide. See, Let's look at the additional financing how it is classified. When additional financing is given, it is leveled at a standard asset, right? If the borrower is performing well within their payment. For interest on this restructured standard asset, it is calculated on accrual basis, meaning the bank record it as income even if it has not been paid yet. However, for loan classified as NPA, it is recognized on cash basis. Already I have told you, right? So according to the RBI guidelines, any restructured should consider borrower ability to repay. Any restructuring should consider the borrower ability to repay. If there is no change in the ownership, interest must still be recorded on cash basis. Now, additionally, we can see restructuring based on borrower repayment capability, interest on cash basis until ownership change. Now, what is the next point? The next point is bank have the option to convert the principal amount of the loan into debt or equity, and any unpaid interest can be turned into FITL. That is called funded interest term loan. These rules help ensure that the bank may make fair decision while supporting the borrower. Now, let's talk about the dissemination of information. See, very important point. So let's discuss the responsibilities bank have regarding willful defaulter, another key issue. If a borrower is a willful defaulter, you know what is a willful defaulter, right? Meaning they have defaulted on a loan of 25 lakh or more. Bank must report this to the CIC, Credit Information Company, within a month. If there are complaints against negligent auditor, bank report this to ICAI, that is Institute of Chartered Accountants of India, the RBI and the Indian Bank Association. The IBA also shared the names of CA firms with multiple complaints. For advocate, for valuers who provide incorrect certification, bank will report them to IBA if the issue is not resolved within 1 month. Now regarding bank loan for promoter contributions. So the bank are not allowed to give loan for buying equity in other company. However, they can finance a specialized company. And that we have, it's regarding the contract of indemnity. So before continuing, many of you were asking about how to get access to such kind of ultra micro notes. So I will tell you that such type of notes is available in our capsule course, and for more detail regarding the capsule course, you can WhatsApp me on this particular number, or you can just see the description section of this particular video. Now let's begin with. So let's quickly break down two important legal concepts, that is the contract of indemnity and contract of guarantee, in the simplest way possible. So indemnity basically means saving someone from loss. It is a type of agreement where one person promises to protect another from certain loss, right? Now the contract kicks in only when a specific event happen or does not happen. So that is called occurrence or non-occurrence. Now under section 124 of the Indian Contract Act, the person who promised to protect is called indemnifier, and then the one who is getting protected is called indemnity holder, or we can say promiser and promisee. Since promiser is there who will promise, and indemnity holder is one who will get protected, right? For example, let me give an example. Let the take the example of insurance. So insurance contract often involve indemnity, right? Though not fully covered under this law. So not covered under the section 124. Court have expanded the scope of indemnity through various judgment, right? A famous case is the Secretary of State versus Bank of India, where the liability was imposed without a direct contract. Sometimes case studies are also asked, remember it. Now let's look at the indemnity versus guarantee. So in indemnity there are two parties, right? The indemnifier and indemnified. In guarantee there are three parties: debtor, creditor and surety. So that's the basic difference. Now liability. So for indemnity, the liability is immediate once there is loss, and for guarantee, the surety is liable only if the debtor does not pay. So the liability is secondary, right? And in the case of guarantee, if you talk in terms of contract, so indemnity involves one contract and guarantee involves three contracts between all parties. And if we talk about the purpose, the main goal of indemnity is reimbursement for a loss, while the main goal of guarantee is more about giving security to the creditor. Lastly, indemnity covers the actual loss, and indemnity holder has the right to recover damage, cost, and other sum related to the loss, right? So now let's talk about the enforceability and of indemnity. So we are talking about indemnity and how it works, especially in banking, in the most straightforward way possible. First, let's talk about the enforceability of indemnity. Indemnity is a promise to compensate for the loss. As we all know, the person who gives the indemnity is called the indemnifier, and he has to start paying when the indemnity holder incurs the loss. So liability start when the indemnity holder incur loss, right? Now, if the indemnity has paid, indemnifier has paid expenses or legal fee, this can be reimbursed, right? So indemnifier can be repaid for the payment made, that is called reimbursement. The indemnity holder can sue for a specific performance if the contract mention it. Now, the indemnity holder should follow direction and stay within their authority. Now, things like legal fee, travel cost, and effort to reduce the loss are all recoverable under indemnity. Now, compromise. Even compromise made to reduce the loss can be recovered as long as they are within the authority. Now, how does this play out in bank? Indemnity is really important for bank. Example, if you lose a check, the bank will ask for an indemnity before issuing a fresh one, right? So in the context of bank, it is very critical for banking operation. For example, I have given you lost check. Now, indemnity is also needed for things like duplicate FDR, death claim, and pay orders. Customer give bank a promise to protect them from any loss or cover any cost that may arise, right? Now, stamp agreement. These indemnity these indemnity are often stamped and sometimes treated as legal bond if it is witnessed. And now there are two sections, section number 124 and section number 125 of the law. It covers the rule of indemnity and the right of the indemnity holder. Now, let's move on to the parties of the contract of guarantee. A guarantee is a promise that if third party can't pay, someone else will pay. A good example is a bank guarantee, where it acts like a security instead of the cash. Now, there are three parties. The first is called surety, the surety who gives the guarantee. The principal lender who owe the money. And lastly, the creditor. Either we call it creditor or we call it beneficiary. Who get the guarantee, who receive the guarantee is called creditor. So surety provide the guarantee, creditor receive the guarantee, and principal letter default cover who owe the money. Now, the surety liability is equal to the debtor and includes things like interest. Now, the bank can go straight to the surety without having to go after the debtor first. So bank can act against surety without pursuing the debtor first. Now, finally, let's wrap up with the basic principle of the contract of guarantee. So the first is the guarantee can be express or implied. It can be either express or it can be implied guarantee. Now, the surety liability only kicks in if the debtor default. Consideration. The guarantee need consideration to be valid, which means something of value must be exchanged. Even if debtor goes bankrupt, the surety still has to play. Right, it still has to pay. So I hope this make everything about indemnity and guarantee contract a little clearer. Right, now let's talk about the guarantor's role. Now let's discuss. So we are talking about surety and how it works in the simplest way possible. So surety is someone who guarantee another person payment or obligation. If the debtor can't pay, the creditor can ask the surety to pay up. There are two types of surety. First is a specific transaction, other for continuing guarantee, which covers multiple transactions. Now let's talk about the liability and remedy. So the surety liability is usually the same as the debtor unless the contract say otherwise, and the creditor must first try to recover the money from the debtor before going after the surety. Right. The surety can also revoke the guarantee for future transaction by giving notice. Death of surety. So if the surety dies, the guarantee is usually terminated unless the contract is specified otherwise. Now, for variance in contract and discharge of duty, let's try to understand. So the surety is only liable if the defaulter, if the debtor default. Already I am telling you. The next point is, if there is a change in the terms without the surety consent, the surety is discharged. So, if there is a change in terms without surety consent, surety is discharged. Remember it. The surety is also released if the debtor is released or if the creditor take any action that releases the debtor from their obligation. And the next point is, if the creditor delays taking action, it does not automatically discharge the surety unless both parties agree for that. Finally, let's talk about the right of the surety, right and co-surety. Once the surety pays, they have the right to claim from the debtor. The surety can recover due after payment, that is claim from the debtor. Now, the surety can also benefit from any security that the creditor hold. right? Then the debtor is implicitly required to indemnify the surety, right? And if there is any misrepresentation, the guarantee become invalid. Remember, invalid guarantee because of misrepresentation. And if there are co-sureties, means multiple sureties, they share the liability equally, and if one is released, it does not affect the other. So remember, they are co-surety, then share liability equally. Now let's talk about the bank guarantee. So in a bank guarantee, the bank act like a surety, right? And promising to pay the customer default. I hope this make the role of surety clearer for you. Now let's talk about let's break down bank guarantee and a bank duty to honor them in the easiest term possible. First of all, what is bank guarantee? So if it is a promise made by the bank to pay if the customer of the applicant default. There are three parties: applicant, who is called borrower, beneficiary, and guarantor. If we talk about the types of guarantee, they are financial guarantee. The bank takes the place of a cash security or earnest money, basically a credit risk. Now performance guarantee, the bank pays if a non-financial obligation like a service is not fulfilled. Now the third is called deferred payment guarantee. The bank promises to make payment in the future. Now bank guarantee are often used with the customer when dealing with government contract, right? So the bank plays a key role in securing collateral and understanding the right and duties. Now let's talk about banker's duty to honor guarantee. A bank guarantee is independent of any dispute between customer and beneficiary, right? And the bank must pay if the guarantee is invoked correctly. No proof of default is required, and there are only two exceptions where court might stop a payment. First case is case of fraud, right? And the first case is case of fraud or special circumstance. Now you can see in the tax Macro case, it was ruled that bank must pay on demand unless there is a fraud or irretrievable injustice. Remember it. There are two cases, right? The first is when there is a case of fraud or special circumstance. And in the Maharashtra Electricity Board case, even if the company goes into liquidation, the bank is still required to pay. Now let's cover the bank obligation under a guarantee. So there is a bank 48-hour rule, which says that the bank must pay within 48 hours of the demand even if it is under liquidation. Now next come after paying the bank handles securities to recover the fund. Under section 128, the bank liability as surety is equal to that of debtor and is not affected by bankruptcy. Again I am telling you, this guarantee remains valid even if the contract between the customer and beneficiary is suspended. But there is one exception: if fraud is evident, bank can refuse to pay. So this is an exception, right? Now before payment, the bank usually inform the customer unless there is a court order stopping them. Now the next is bank guarantee, fraud, liability, and validity. Try to understand. See, we will talk about bank guarantee as something to watch out for, like fraud, liability. For a bank to refuse payment, fraud must be proven, right? If the bank is unsure, it may seek direction from the court. In normal situation, the bank cannot refuse payment unless the fraud is clear. Now court might stop payment to prevent irreparable harm if the paying the guarantee would lead to injustice. Next, we need to know about how to avoid unlimited liability, right? How to avoid the unlimited liability. Guarantees should clearly specify the amount and period they cover. This avoid any confusion about what the bank is liable for. Banks should also secure a counter guarantee, right? Banks should also secure a counter guarantee from their customer for extra protection. When it's come to the validity and claim period, so bank is only liable for default that happen within the validity period, but there is a claim period that gives beneficiary extra time to make claim even after the guarantee expire. Thanks to the section 28 amendment in 1997, any clause limiting claims during this period are illegal. What happens if the bank does not pay on time? So if the bank does not honor the guarantee within the claim period, the beneficiary can sue them. That is called legal recourse. Now let's move on to the precaution that banks should take. When a guarantee expire, the bank should ensure that they get the cancelled guarantee back or confirmation that there are no claim. To protect themselves, bank use a counter guarantee. That is counter guarantee cum indemnity to cover payment amount, legal cost, interest, and more. Now these counter guarantees should be backed by tangible asset like fixed deposit, security, or property. Now lastly, when it's come to the payment precaution, before making any payment, the bank need to ensure that guarantee has been properly invoked. Court may have different rule. For instance, the Delhi court, as you can see, For instance, the Delhi court require a cause of action, while the Calcutta High Court allows a more flexible invocation, right? So that is all about. Now let's talk about the proper invocation of the bank guarantee. So see, how to properly invoke a bank guarantee and the bank obligation when it comes to guarantee. To invoke a bank guarantee, it must be done within the validity period. Again, I am telling you. And now the second point is that it is crucial that the amount being claimed should be less than or equal to the guaranteed amount. So the invoked amount should be less than or equal to the invoke amount should be less than or equal to the guaranteed amount. Remember it. Now it is crucial that the authorized authority invoke the guarantee. For example, in government cases, the right person need to be designated to make this request. According to the Supreme Court ruling Hindustan Construction Corporation Limited versus State of Bihar, if someone unauthorized invoke the guarantee, the bank is not liable. Now let's talk about the court interference. Court rarely get involved unless there is a fraud or a special equity in this case. In one case, GS Atwal Co-Engineer versus Hindustan Work, the bank issued a wrong guarantee and the court favored the petitioner due to the specific equity. Now let's talk about the bank obligation. So the bank duty to pay is independent of any contract between customer and the beneficiary. However, there are exceptions to this payment if fraud is involved and if there is special equity, right, it must be proven beyond doubt. Now always ensure that the guarantee clearly states the amount and period to avoid any unlimited liability. It is wise for bank to secure counter guarantee. Finally, bank must ensure that the guarantee is properly invoked by the authorized authority. Now let's talk about the letter of credit. This is very important topic which we are going to discuss now. So letter of credit guarantee payments to the seller in international trade upon presenting the required document. So once the required document is presented, it guarantees payment. It is issued by the buyer's bank in favor of seller, specifying terms and limits. Now here is a quick example. An Indian buyer imports goods from UK. The payment is made by LC through the respective bank. So the buyer issues the LC from the local bank. This LC is then sent to the seller bank overseas. The seller ships the goods, present the document and receive payment via their bank. Finally, the buyer pays the local bank after verifying the document. Now let's look at the parties involved in the letter of credit. First is the applicant. Applicant is the buyer or importer requesting the LC. Issuing bank open the LC for the buyer. Now there is something called beneficiary. So beneficiary is the seller or exporter entitled to receive the payment. Now advising bank confirm the authenticity of the LC to the seller. So advising bank confirm that LC is authentic to the seller. Negotiating bank pay the seller for document and can be any bank or a specified one. Then there is a confirming bank, added guarantee to the payment if the seller has doubt about the issuing bank. Lastly, the reimbursing bank handles the reimbursement for the issuing bank. Now let's discuss the bill of lading. Bill of lading is negotiable and issued in set of 2 to 4 original. It must state that the goods are shipped on board. An airway bill, you can see, an airway bill is not a title to good but is accepted if it is specified in the LC. Right. Next is post parcel courier receipt. It is similar to airway bill and also does not serve as a title of good. Now insurance document. So insurance document are required by the LC and must detail the coverage, risk, currency and claim information. Additionally, there are other documents like certificate of origin, weight, quality and health which are mandatory for payment. Lastly, we have UCP 600. UCP 600 was approved by the ICC, right, on October 25, 2006, and it replaces UCP 500. It consists of 39 articles, okay, and reduced from 49 with added definition and interpretation. Now document handling. For document handling, bank now have 5 banking days, right, to accept or refuse a document, replacing the previous reasonable time. UCP 600 allows for deferred payment credit and under discounting. An EUCP include 12 articles on electronic or part electronic presentation. Finally, negotiation is defined as the purchase of draft or document. Right. Now let's talk about the types of letter of credit. So as you know, there is something called acceptance credit. Acceptance credit involves payment at the maturity of your chance bill. There is something called irrevocable credit. So once issued, this credit cannot be altered without the beneficiary consent. There is something called confirmed credit. So here the advising bank guarantee the payment to the beneficiary with and without recourse. So it is in without recourse scenario, the beneficiary remain liable unless it is marked without recourse. So in with recourse, beneficiary remain liable. Now there is something called transferable credit. So this allows the beneficiary to transfer their right to the third party. Back to back credit. In this case, the beneficiary open another LC for their supplier. Red clause LC. This type allow for advance before shipment. Green clause LC. Similar to red clause but also cover advance for shipment and storage cost. Revolving LC. This credit automatically renew for new trade transaction. Let's move on to the document required under letter of credit. First we call doctrine. It is crucial to understand the doctrine of strict compliance and the independent nature of the LC. Strict compliance means all the terms of LC must be followed exactly. Any deviation can jeopardize the claim to payment, and if the party default, they risk losing claim to the payment. Now, the bank duty is to ensure that document matches the terms of the LC presently. No substitution are allowed. Only exact document will be accepted. Issuing bank must verify the document aligning with the customer instruction, and if a bank default, it must lose its right to reimburse or remuneration. A letter of credit is honored only if the document conforms to its term. Required document typically involve bill of exchange, invoice, transport document. The invoice must match with the LC and be in the buyer's name unless otherwise specified. Transport document like bill of lading, airway bill are also required according to the contract of law. Begin with the first concept that we have. So in the first slide we are going to break down a key concept in banking that is called DPG. What is DPG? Deferred payment guarantee and bill finance. So now a DPG is a promise by the bank to pay for goods bought on installment. Imagine you are buying a machine but can't pay the full amount. So you are buying a machine but can't pay the full amount upfront. The seller agree to let you pay over time, but they want assurance. Obviously seller will need assurance, right? So that is where the bank steps in and guarantee your payment even if you can't. Right. So I have given you an example. You are buying a machine, seller is trying to and you want but can't pay the full amount upfront. The seller agree to let you pay over the time, but he want assurance, and that is where this particular bank step in and guarantee your payment. Now how does it work? You see, it's quite simple. Usually it's you pay 10 to 15% upfront, right? Another 10 to 15% when document like letter of credit are received, and rest in installment over 9 to 7 years. Usually you pay 10% upfront, 10 to 15% when document like letter of credit are received, and the rest in installment over 1 to 7 years. Now the bank does not check the quality of the goods, it guarantee the payment. That's the role. Bank provide unconditional payment guarantee, does not verify the goods quality. Now the guarantee is unconditional, meaning the bank must pay, no question asked. If you miss a payment, it is also irrevocable. You can see written here, it is irrevocable. It is unconditional, it is irrevocable. So bank guarantee payment of installment including interest, liability is independent of the contract. Now the guarantee is unconditional, meaning the bank must pay, no question asked, and irrevocable means once given it can't be taken back. That is the meaning of this irrevocability. Hopefully you have understood. Now let's talk about the bill finance, right? So let's talk about something more important called bill finance. This is when bank help businesses by buying or discounting commercial bill, either by discounting, either by purchasing the commercial bill. It is a way to get quick cash while ensuring fixed payment return. So you will get quick cash while ensuring fixed repayment terms. Now there are different types of bill, you know, like you can see written here: clean bill, documentary bill, bills under credit. Each has a specific condition, but they all fall under Negotiable Instrument Act, that is NI Act. Now there are three parties to a bill, as you know. The first is the drawer. The drawer is the one who has owed the money, that is the creditor. Drawee is the one who owes money, that is the debtor. And the payee is the one who get paid. That's a quick breakdown of DPG and bill finance, right? Now let's talk about the transferability. So bills can be easily transferred. Holder in due course is entitled for the payment, right? Whoever is holding the bill and he is in due course, he will be entitled to pay the bill. Now let's talk about negotiation and endorsement. First up, let's talk about negotiation. When you transfer a bill for a money, that is called negotiation, right? You are transferring a bill for money, for consideration. When I say consideration, I mean money. So you are transferring bill for money, that is called negotiation. And if you sign the bill to transfer it to someone else, that is called endorsement. Endorsement means what? You are signing a bill to transfer it to someone else, to third party. Now what are the liabilities of drawer? Try to understand. Here is the important part about who is responsible for paying the bill. The drawer. You know the meaning of drawer? The one who has owed money has to step in if the drawee, the one who owes money, can't pay, but only if they are notified of failure. Now the acceptor. Acceptor is, what is the liability? Who is the acceptor? Acceptor is the person who agreed to pay the bill. So the acceptor is responsible for pay when the bill is due. It is responsible for paying when the bill is due. And if someone endorses the bill, what is his liability? Endorser. So and if someone endorses the bill to another person, they are also liable if bill is not paid. Now let's talk about the interest rate. Interest rate on bill are either mentioned directly, or if not specified, they are 18% per year. So always check the detail. Now if we talk about the types of bill classification, there is something called inland bill. Inland bill are made and payable within India. Foreign bill are made outside India but could be paid either abroad or in India. There is something called demand bill. Demand bill are payable right away, no waiting period, right? Payable on demand. As and when demand come, it will be paid. Usance bill need to be paid after a set period, like 30 days, right, after sight. Now documentary bill. So the documentary bill comes with document like bill of lading, while clean bill don't have any document attached. Now you can see there are some more types of bill you can see here, like DP bill. So let's see what is this DP bill in the next slide, right? So when I say DP bill means it required document to be handed over only when payment is made. Means once the payment is made, you will give the document. Clean bill, no document of title attached. Documentary bill accompanied by document of title of goods. DA bill. So DA bill means document to be handed over when acceptance is given. So A stands for acceptance, right? So document to be given when acceptance, document to be handed over when acceptance is given. It means that the buyer agree to pay later, right? So buyer will agree that I will pay later. Buyer agree to pay later. Remember this thing, okay? And in the case of DP bill, it required document to be handed over only when payment is made. First you made the payment and then I will give you the document. But in case of DA bill, what it says? It says that okay, I am giving you the document, but you should pay the bill at the time, right? Now let's talk about the supply bill. Supply bill are special. Why it is special? Because they are used when drawing bill on government department for good supply. So that's your quick guide to bill in banking. Now let's see the type of bill finance. So the first type is called bill purchase. What is the meaning of bill purchase? Bill purchase means when the bank negotiate demand bill. This could be clean or come with document. So whenever bank negotiate demand bill, and I already told you what is the meaning of this negotiation, right? Do you remember what is the meaning of this negotiation? Just I have told you that how does this particular term negotiation work. See, in the previous slide, let's see what is the meaning of negotiation. You can see that transfer of bill for a consideration. You are transferring the bill for some payment, right? Giving the right to claim. That is called negotiation. And in the case of bill purchase, the bank negotiate demand bill. It can be either clean or it can be either documentary, right? Now let's talk about the next part, that is our bill discount. So this is another kind of bill finance. So when I say bill discount, it means here the bank buy usance bill but at a discount, meaning they pay you less than the face value of the bill. That is called bill discounting, right? So they buy the usance bill. When I say usance bill, what does it mean? That payment will be made after certain date, right? So bill purchase means when bank negotiate demand bill. See the kind of bill. If it is demand bill, then negotiation will be done. If it is usance bill, then bill discounting will be done. Remember it. Okay. And something called ABC, advance against bill for collection. The bank gives you an advance while the bill are being collected. Now what is the usance bill due date? See, usance bill is due on a specific date after being presented to the buyer. The bank become the holder in due course. Obviously of this bill, the bank become holder in due course, as you can see written here. And meaning they have the right to get paid. Even if the bill is dishonored, the bank can recover the amount from the borrower. If the document like bill of lading are involved, ownership of good can also transfer with endorsement. Now let's talk about the legal framework, that is NI Act 1881. All of this is governed by the Negotiable Instrument Act 1881. It defines the rules for bill of exchange and outlines the debtor-creditor relationship between the parties. Right. Now let's talk about this co-acceptance facility. Sometimes the bank might co-accept a bill with a borrower, meaning both share the liability. It is a way for bank to offer support but also share the risk. Now let's move on to our next topic, that is our credit card. You can see credit card, this card let you make a purchase without paying upfront. The credit is offered by the bank and you pay later. Now what are the parties involved? Cardholder, like that is you, the issuer, that is the bank, the merchant where you use your card, merchant acquirer who help in process the payment, credit card associate like Visa or MasterCard. What is the benefit for cardholder? The first is cashless purchase, instant free credit period, ATM withdrawal, proof of purchase, and then they have additional benefit like insurance or discount. What is the benefit for merchant? The for merchant, credit card means more sales, means happy customer and less need for offering credit themselves. Now let's talk more about this particular credit card. So what is the RBI guidelines? What are the, I've told you the advantage and disadvantage, convenience, security, etc, etc. Okay, what about the RBI guideline? So before issuing a credit card, bank or NBFC must follow a strict KYC rule, that is know your customer rule, to verify your identity. They also use direct sale agent, that is called DSA, direct sale agent, to promote card, but it is the bank job to assess your credit risk and decide whether to use the card. Now what are the key requirements for credit issuance? Whether when you apply for a credit card, you will get a key fact statement. What you will get? You will get a key fact statement with all the important details. If your application is rejected, the bank must provide a written explanation, and don't worry, bank can't report your credit information until your card is activated. Remember, that is what, no credit info reported before card activation. Transparency and terms. See, everything must be transparent. That when I mean to say everything transparent, that is EMI conversion. That it should be clear, and any loan offered through the card have to be follow RBI guideline. Insurance tied to the card. Right, if insurance is tied to the card, that require your written consent, including detail of the nominee. Now let's talk about the types of card. There are different types of credit card like co-branded, corporate and add-on credit card. Bank must explain the terms and let you know how long it will take to issue the card. One key rule is that cards that are sent deactivated can only be used once you accept and activate it. Now let's talk about how to manage your credit card. So you can see card issuance and management. So banks are required to give you all the terms and conditions upfront. If they want to change anything, they have to notify you at least 45 days in advance. Remember it. Your card security is a big deal. Card now come with EMV chip, right? The card, any card that comes with EMV chip and require PIN for safety, right? And if your card is lost, it must be blocked immediately. You will also get an SMS or email alert for every transaction, and there is something called two-factor authentication for online purchases, right? If something goes wrong like incorrect billing, the bank has to fix it within 30 days. Remember it. These days are very important. It can be asked. It has to be fixed within 30 days. Remember it. Now the next thing is that if your complaint is not resolved, it get automatically escalated to a higher officer. To keep your card into information safe, many banks use something called tokenization. Right, so there is something called tokenization which is used. These which replace your actual card detail with a token for safer online transaction. Right, now let's talk about credit card eligibility and uses. See, first up, let's take the eligibility for credit card. The bank will check things like your income, your credit history, and to decide if you qualify. When it comes to uses, cardholder must comply with law, and the bank has to be clear about any fees, charges, and interest rate. Remember, no ads on card for minor, and the main credit card holder is responsible for all transaction. Credit card, have limits, and if you get an add-on card, it will have a lower limit. If the bank lower your card limit, they must inform you with reason. And for a statement, you will receive a monthly statement showing all your transaction, either by post, email or online. And before reporting a default to credit information company, bank must follow proper procedure. Right, now interest rate need to be reasonable and transparent, especially for free cards. Bank must explain how financial charges are calculated with example. You will also get enough time before interest charges kicks in, and they must clearly state the annual percentage rate, that is we call it APR. You can see written APR must be quoted with calculation example. Even if you made a minimum payment, interest will still apply on the remaining balance. The bank must give you at least 1 month notice before changing any fees or terms. So this is called APR. Sufficient time should be given, right, before interest charge kicks in, and they must clearly state the APR, that is annual percentage rate. Now let's talk about the want to cancel your card. The process should be quick, and the bank must confirm once it is done. Now home loan. This loan can be used to buy a house, right? As you know, so the loan amount depends on your income, age and the cost of the house. Repayment period can goes up to 30 years, not exceeding retirement age or 70 years. And just like credit card, your credit history plays a big role in getting the loan. Bank checks your credit score and past financial behavior before offering terms. And let's talk about the home loan security and finance. So when you take a home loan, the property is typically mortgaged to the bank. In many cases, your spouse or joint owner can also act like a co-borrower or even guarantor for the loan. The interest rate on the home loan can be either fixed or floating, depending on the bank policy. Fixed rate stays the same throughout the loan, while floating rate rate change based on the market rate. Home loan cover a wide range of purpose. You can get a loan for buying a plot with the intention to build on it, purchasing a home, constructing a house, or even making repair to your property. Some loans are also available for second home or rental property. Now, if you are building or buying, you will need a sanction plan and completion certificate, right? Also, bank typically won't finance properties unless you use for commercial purpose. Now, bank must make sure to inform borrower about the risk and liability involved in the loan. Keep in mind the interest rate you will get depend on the loan tenure and how long you plan to repay the loan. If you need any additional funding for house alteration or repair, bank offer extra loan, right? That is called supplementary finance. However, there are some restrictions. Bank don't finance property like government or semi-government offices or non-commercial project, right? Now, lending to housing intermediary agency. What is all about? See, first, bank can finance public agencies, not private builders, right? For land acquisition and development as a part of complete project. The loan amount is based on the acquisition price minus developmental cost. You can see, and plus the development cost, and the market price is usually the collateral. For housing finance institution, that is called HFC, bank can provide term loan based on factors like what is the institution based debt to equity ratio, track record, and recovery performance. Bank can also give loans to the state housing board, public agencies, but they need to be ensured to prompt recovery. For private builder, bank offer credit for a specific project on commercial term and must monitor carefully to avoid land speculation. Now, there is something called term loan for agencies. So, a term loan are allowed for direct lending to intermediary agency, but they must stick to the RBI norm. Next comes LTV ratio, very important. That is called loan to value ratio. What is this LTV ratio? See, how bank decide the amount of loan they can give based on the price of property use. Generally, stamp duty, registration, documentation charge excluded when calculating LTV. So, however, for loan costing 10 lakh or less, these charges can be considered. Now, while applying for a home loan, you will need some key documents, including the sale agreement or deed, and a nil encumbrance certificate, a 30-year title search, and the approved building plan, patta, and valuation report. You will also need to provide 12 months of your bank statement, right? Your salary certificate, IT returns, KYC, and of course your KYC document. There typically processing fee of around 1% of the loan amount. And then the loan documentation must also include the insurance for building covering risk like fire, earthquake, and flood. Plus, to make EMI payment easy, you can set up an NACH, that is National Automated Clearing House, that have wrap up on how bank finance housing intermediary. Now, if you talk about the personal loan, they are typically offered without any tangible security, which means you don't have to place any asset. These loans are available to salaried employee, pensioner, and professional. For salary loan, bank usually offer them to permanent employee who have been working for at least 3 years in the government job, well-known companies or corporate organization. The loan can help cover things like marriage, education, medical expense, or household expense. Now, if we talk about the eligibility, so eligibility for the loan is based on your income, whether it is your gross or net salary. Loan amount can be higher if your employer agree to directly remit EMI to the bank. Sometimes, if you don't have collateral security, bank may ask for a third-party guarantee. Your employer can also give an undertaking to help your EMI recovery. Lastly, you will need to submit some key document like proof of employment and salary certificate. So that's all about this part. So let's begin with. So friends, banks in India that have more than 20 branch, right, must give 40% of their loan to the priority sector. These are a specific category that need more financial support. Like you can see agriculture. Agriculture means 18% of the loan should go to the farmers, and from this 10% must go to the small and marginal farmer. For micro enterprise, that means small businesses, they should get 7.5% of the loan. And for weaker section, the 12% of the loan should support them. That these are the poorer people. Now, but there are foreign bank with less than 20 branches. So these bank also have to meet the 40% target for the priority sector lending. But here is the twist. 32% for export and at least 8% to other priority sector like agriculture or small businesses. RRB, Regional Rural Bank, and Small Financial Bank, these banks have higher responsibility. They must lend 75% of their loan to the priority sector. Agriculture 18% with 10% for a small and marginal farmer. Micro enterprise 7.5%. Weaker section between 12 to 15%. Now, agriculture lending, it includes loans like loan for farming, setting up farming infrastructure like warehouse, and services like transport. There is a 100 crore limit for agriculture infrastructure loan. You know about NBFC? non-banking financial company and an MFI can lend for these loan. Now MSME loan. So loan for a small and medium enterprise are important. Factoring a way for business to get quick cash for invoice is allowed. Loan for Khadi, KVIC, you can see. Loan for KVI loan, Khadi and village industry and agriculture export are also covered. Other type of loan you can see, export credit. Some banks have a special rule for this, but it does not apply to all banks. Education loan, so for students it is included under priority sector. Housing loan for buying, repairing homes and affordable housing schemes. Social infrastructure, that means this help build school, clean water, toilet and especially through microfinance. Now let's talk about the renewable energy loans. So friends, banks also give loan for renewable energy project like solar, wind or biomass energy. If you talk about the other kind of loan, you can include the social loan. So loan to individual or group of for basic need like house repair or toilet, right? You can see it here. Now, so that's a quick summary of priority sector loan. Now let's talk about some state sponsored loan. So bank also support loan for organization that can help a specific group like STSC, as a scheduled caste, scheduled tribe, a startup that are not a part of the agriculture or MSME. Now weaker section, loan for weaker section include a small and marginal farmer, SMF, artisans, village industries with loan up to 1 lakh, people from SC STs, women, the disabled minority and those under the differential rate is DRI scheme, you know, differential rate of interest scheme. What happen if bank don't meet their priority sector lending target? See, if bank falls short of this target, the extra money get contributed to the various fund like RIDF, that is Rural Infrastructure Development Fund, NABARD for rural development, NHB for National Housing Bank, SIDB for small industries, Mudra for micro enterprise. Even Urban Cooperative Bank, that is called UCB, also contribute. The interest rate and duration of these funds are set by the RBI. If we talk about the priority sector loans rules, the RBI control the interest rate. For a small loan up to 25,000, no extra charges are allowed. Bank must maintain proper record and inform customer quickly about their loan decision. Now, what are the other way to meet priority sector lending? So, bank can use a securitized asset like bundling loan and selling them, IBPC, interbank participation certificate, PSLC, priority sector lending certificate, NBFC on lending, that is partnering with non-banking companies to lend. Now, there is something called interest subvention scheme. So, which means offering loan at lower interest rate. If we talk about the crop loan farmer get loan at just 7% interest for amount up to 3 lakh. NRLM, that is National Rural Livelihood Mission, Women Self-Help Group, SHG also benefit from reduced interest rate. Now if we talk about the KCC, that is Kissan credit card, is a handy credit system for farmer, and here it how it work. Direct finance, loan for farming activities like buying seeds, fertilizers and tool. Short term loans are for up to 18 months, less than 18 months, and medium term long term loan are for more than 36 months. Now indirect finance cover things like buying fertilizer, pump set, storage, etc. Now the question is, who can get KCC, that is eligibility? Farmer, tenant farmer, JHG, SHG, joint liability group and SHG. What is the purpose? So the purpose is farming and post harvest need plus related activities like dairy and fishery. Now let's talk about the KCC for marginal farmer. There is a flexible KCC for a small farmer with limit between 10,000 to 50,000. Now if we talk about the farming cost, so post harvest need and small investment, these are included. Now KCC for animal husbandry and fisheries, farming in these sectors can use KCC for recurring cost like feed and seed. The loan work like revolving cash credit, right? The loan work like a revolving cash credit, meaning they can borrow and repay as needed. Now that's a wrap on this session. Now let's talk about animal husbandry and fisheries KCC. So friends, farming involved in animal husbandry, farmers involved in animal husbandry like poultry and dairying or fishery also get their own KCC, Kissan credit card. Here is what you need to know. Each farmer has a separate account or a smart card, right? So every farmer should have separate account or a smart card to track how the money is used. Eligible group include fishers, poultry farmers, dairy farmers, and even SHG or JLG, self-help group and joint liability group. KCC covers loans covers recurring cost and like feed and seed, and the money can be easily accessed through ATM or mobile banking. Now if we talk about the KCC loan detail, so for loan up to 1.6 lakh, farmer don't need to provide any margin money, and if there is a recovery agreement in place, loan can go up to 3 lakh without margin. If we talk about the security, loans are secured by hypothecation of the crop. The crop act like a security. For amount above 1.6 lakh, bank may ask for collateral. Insurance, so sorry friends, farmer can also get asset insurance. a personal accident insurance and health insurance under the KCC. Farmer who repay loan on time get an interest subvention, meaning they pay less interest. Farmer can also use warehouse receipt to link loan to the shared crop. Now agriculture term loan. See, these are loans that farmer can take for long-term projects like buying equipment, developing land, or starting activities like dairy farming or irrigation, right? And these loans can be repaid for more than 3 years. Now, who is eligible? Farmer and farm labor are eligible. What is this thing for? So things like land development, dairy farming, sericulture, irrigation, and even land purchase. So these are eligibility. Now let's talk about the MSP, that is minimum support price. So how the government makes sure farmer don't lose money when they sell their crop. So the MSP, that is the minimum support price, is the fixed price at which the government buys crop from the farmer. This prevents them from having to sell at low price when there is a surplus. So the Food Corporation of India and NAFED buys the oil seed, pulses and cotton. These are the nodal agency. The government set MSP for 25 crops that may include Rabi and Kharif across the two main farming season, that is Rabi and Kharif. Now there is something called PM ASA scheme. So this scheme is ensure that farmer get fair price for their crop. It includes PSS. You know PSS, that is price support scheme. So the government buys crop at MSP. There is something called PDPS, that is price deficiency payment scheme. If the market price is lower than the MSP, the farmer get paid the difference. And there is something called PPP, that is private procurement and stockist stream. So the private company can also help buy crop at fair price. Now there is something called PMFBY, that is Pradhan Mantri Crop Fasal Bima Yojana, that was crop insurance scheme in 2016. So it replaced the old crop insurance scheme. This is how farmer can protect their crop from disasters like drought, flood and pest. Now what is covered inside it? So it covered loss in crop yield due to natural event like drought or flood. Farmer can choose optional add-on. So they can choose this something called optional add-on, right, for more specific risk. It is important to know that Aadhaar is mandatory to apply for this insurance, and the premium is subsidized by the government. Now let's talk about the NBFC. So NBFC means non-banking financial company. They play a big role in our financial system. But what exactly do they do? Let's break it down into simple terms. So NBFC are companies that offer financial services like loan and advance, right? They offer leasing, right? Leasing means renting out equipment or asset, and they also offer insurance and securities. But they don't deal with things like agriculture or industrial activity. Some NBFCs like NBFC MFI focus on micro loan to help financial inclusion, that is bringing banking services to the undeserved people. Those other NBFC like HFCs, that is housing finance companies, specialize in providing housing credit. Now let's talk about where do NBFC get their money. So NBFC get their money from different sources like public deposit with RBI approval, debentures, that is a type of loan NBFC can take, and the bank borrowing and the commercial paper. Banks are really important for NBFC because they provide funding that can help NBFC lend to people who might not get loan from regular bank, especially in priority sector like microfinance and housing. Now if we talk about the bank loan to NBFC, so bank finance, yes. So bank lend money to NBFC based on factors like the quality of the asset, right? So they look at the quality of the asset, and they also look at the purpose of the loan. They look at the risk involved. Some NBFC like MFI, Nidhi, right, and cheat company don't need to register with RBI, right? But most do. Now the question is, what bank loan can't be used for? Very important. So there are certain things that bank cannot lend money for, like bill discounting except for vehicle, investment in NBFC except a stockbroker, unsecured loan, IPO funding or loan for leasing deals. Also shares and debentures are not accepted as a collateral by the bank, and bank can't guarantee loan given by NBFC. Now the next thing is bank exposure and on lending to NBFC. So bank also have limit on how much they can lend to NBFC. They can lend up to 25% of their tier 1 capital to one NBFC group. And for gold loan NBFC, this is capped at 7.5%. Now bank can also lend to NBFC for on lending to priority sector like microfinance through MFI, that is microfinance institution for SHG and JLG, and a housing loan through HFC. There is cap on how much bank can lend to NBFC for this sector, which is 5% of their total priority sector lending. Now if we talk about bank loan to NBFC MFI, so now let's focus to NBFC MFI, which is specialized in microfinance. This means giving a small loan to help people, especially in rural or semi-urban area, access financial service. So what is the minimum net on fund? So the minimum to qualify an NBFC MFI need at least 5 crore in on fund or 2 crore if they are in northeast state. Now if we talk about the qualifying loans, So 85% of their asset must be in qualifying loan, which means loan that meets a specific criteria. If we talk about the borrower eligibility for people in rural area, their income should be to 1.25 lakh or less. For urban and semi-urban area, the limit is 2 lakh. Now if we talk about the loan limit, for the first loan cycle the limit is 75,000, and for the second loan cycle it can goes up to 1.25 lakh, and a borrower total debt can't exceed 1.25 lakh, but this does not include education or medical loan. If we talk about the loan tenure, so the loan offered rupees 30,000 need to have a minimum tenure of 24 months, but prepayment is allowed. So that's for NBFC MFI. Now let's talk about the prudential norms. So NBFC MFI is need to keep their capital strong to support their loan, and this is known as capital adequacy, and here what it means. So they must maintain 15% of their risk weight and capital. So this capital come from two types. The capital one, tier 1 capital, which includes main capital like shareholder equity, and tier 2 supplementary capital like reserve. One rule is that tier 2 capital can't be greater than tier 1 capital. Remember it, very very important. If you talk about the asset classification, NBFC MFI must classify their loan as either a standard asset. These are loans which have where no payment are overdue, or either non-performing asset. If the payment are overdue for 90 days or more, the loan is considered NPA. Now so that's the point. When loan become overdue, NBFC MFI is needed to set aside money for possible loss. This is called provisioning. So 1% of their loan portfolio must be kept aside. Remember it, 1% of their loan portfolio must be kept aside. For loan overdue by 90 to 80 days, they need to set aside 50% of the loan amount, and for loan overdue by more than 180 days, 100% provisioning is to be kept aside. Now if you talk about the credit information and pricing of loan, so this NBFC MFI must report loan data to all CIC, that is credit information company, and ensuring accurate data on borrower. And for interest rate, the margin cap is 10% for MFI with portfolio of 100 crore plus, above 100 crore, and 12% for a smaller MFI. They must offer the lower of the two interest rate. First, the cost of fund plus margin, and the second is 2.75 times of the average base rate of the 5 largest commercial bank. Now branch authorization, at least 30% of the branches must be in unbanked rural area, and in the first 5 years they can only expand to 1000 branch. Now if we talk about the governance and lending norms, so this NBFC MFI need to have good governance, meaning they should be transparent and free from political interference. Their board of directors must include one independent director and an audit committee with at least 3 members. You can see written here, audit committee with at least 3 members is required, and board must meet at least 4 times a year. If you talk about the lending rule, so they can lend to individual as well as the joint liability group as well as the self-help group. Only a maximum of 2 members, 2 NBFC MFI can give loan to the same borrower, and the processing charge should be no more than 1% of the total loan amount. Right, now let's talk about some more points like multiple lending over borrowing. So the new network, the new framework divide NBFC into 4 layers, as you all know, based on how big they are and the type of risk they handle. Like you can see, the first is called yeah, you can see it here, NBFC base layer, that is called BL. So this is the smallest and less risky company. Then there is something called NBFC middle layer, and then the NBFC upper layer, and the NBFC top layer. So some specific type of NBFC like NBFC peer-to-peer lending, NBFC asset aggregator stay in the base layer, and the government on NBFC are generally placed in either the base layer or the middle layer. Now NBFC competitive edge, they have a deep understanding of NBFC stand out because they have a deep understanding of the regional needs and dynamics. Their collection system are efficient. They offer personalized services tailored to their client, especially in local area. One of the key role of NBFC, especially an NBFC MFI, is to promote financial inclusion by offering loan and services to the poor and household income. If you talk about the funding source, so the major source of funding for NBFC is bank borrowing, including NBFC MFI that engage in microfinance. If you talk about the co-lending arrangement, so you know, this RBI has introduced a co-lending arrangement for bank and NBFC, replacing the old co-origination scheme. This allow bank and NBFC to jointly lend to customer, making credit more accessible. And now there is something called SBR framework. This scale-based regulation cover various aspects of NBFC regulation, especially focusing on capital requirement to ensure NBFC operates safely and efficient. The first topic, that is our MSME. So micro, small, medium enterprise. So these businesses are the backbone of our economy, and we will break down how they are supported and what help them grow. Now what is the aim? As you can see, so MSME are all about boosting competitiveness, right? So they focus on infrastructure, technology, and like through Surety and quality. Plus, thanks to the Delayed Payment Act, you know about this Delayed Payment Act? Thanks to the Delayed Payment Act, MSME get their payment on time. Now, support for MSME. If we talk about the support, they have credit scheme to help. So they offer credit scheme to help, like loan for tech upgradation and even collateral free loan. Now there is something called MSME Act 2006. So this act encourages domestic production and export, and making it easy to start with low investment. But there are challenges like limited capital and not enough exposure to the global market. So these are the major challenges here. Now let's talk about this MSMED Act 2006. So this act defined MSME, replacing the word industry with enterprise. In 2020, the classification changed to focus on new investment and turnover. Now business must registered with Udyam. So Udyam registration is mandatory. Now how MSME are classified? So if a business grow beyond the limits, it moves to the next category. From March 2021, MSME needs to have GSTIN and PAN for classification. Now let's talk about financial support. So MSME are a priority for bank lending. Organizations like Surety offers access to venture capital. Plus, the LLP Act 2008 encourages MSME to become corporate entity. Now, so MSME have a strong support system, from credit scheme to priority lending and policies that ensure they get the help they need, right? So now let's talk about the second topic, that is our MSME and promotion and competitiveness. So we are diving into how MSME get access to the credit and the unique concept of cluster financing, right? So credit, so there is something called CGT MSE, right? So what is this all about? See, since 2000, MSME can get collateral free loan through the CGT MSE. These loans are backed by the government, offering up to rupees 50 lakh for the small bank, and up to 200 lakh, that is 2 crore, for the larger bank like SCB, NBFC, RRB, FI. These are come to a small bank, right? So there are also hybrid option, which is a part of the loan is secured with collateral and the rest is backed by the MSME. That is called hybrid security, up to 2 crore, that is 200 lakh. Now there is something called CGSCL, that is called Credit Guarantee Scheme for Co-lending. See, under this, bank and other lender can jointly lend to MSME. They offer secured loan up to 200 lakh. So up to 2 crore they offer secured loan, and unsecured loan up to 100 lakh, that is 1 crore. The lender takes care of everything from approving the loan to handling default. So everything is taken care of by the lender. Remember it. Now there is something called cluster based financing. So MSME that produce similar product in one region form a cluster. So MSME in a region producing similar product, they form a cluster. This approach lower cost, so because of this cost decreases and also risk decreases, right? And since cluster contribute to 60% of Indian export and employment, it is a big deal for the economy, right? So that is called cluster based financing. This approach lower cost and risk, and since cluster contribute to 60%, so this cluster contribute to 60% of the Indian export and employment. It is big deal for the economy. That is called our cluster based financing. Now there is something called UNIDO cluster. What is this UNIDO cluster? See, UNIDO has identified over 6500 plus cluster across 21 states, right? And they produce item like what kind of item they produce? Like textile, they produce item like handicrafts, food and engineering goods. So these cluster are vital for employment and export. That is called UNIDO cluster. Now if we talk about the bank and cluster, so you can see banks are the key player here. They are encouraged to focus on cluster by opening MSE specific branches and supporting cluster in each district. The goal is to boost credit flow to this group. Now so MSME not only get government backed loan but also benefit from cluster financing, which has strengthened the entire region. So you can see the UNIDO based cluster financing, and also we have seen what is this cluster financing, right? So these two examples clearly explain this. Now let's talk about this MSME credit scheme. So First thing is composite loan. What is this composite loan all about? Let's try to understand. See, MSME can get loan up to 1 crore for working capital and term loan combined. So that is called composite loan. There is something called GCC scheme. GCC scheme offer credit for productive activities in the priority sector. So for offering productive activities in the priority sector, this GCC scheme was launched. There is something called CLSS. CLSS provide loan up to 1 crore with a 50% subsidy for buying plant and machinery. So that is called CLSS. It provide loan up to 1 crore with 15% subsidy for buying plant and machinery. There is something called debt restructuring, right? So a solution for MSME facing financial stress is called debt restructuring. It allows restructure of loan up to 25 crore, right? That is called debt restructuring. Now there is something called special MSME branches. So bank must have at least one MSME focused branch per district to improve access to credit. Now let's talk about some government programs. That is, the first program is DNRLM, that is called Din Dayal Antyodaya Yojana, National Rural Livelihood Mission. So this program aims to reduce poverty by building strong institutions for rural household. Now here how it works. The first is universal mobilization. It creates self-help group with one member from every poor rural household focusing on women. Now there is something called identifying the poor. So the SECC, in short we call it the SECC, it helps the target household that need support. Now SHG, that is self-help group, and their federation help reduce reliance on external loan and improve credit access by training member. Now let's talk about this financial inclusion. So SHG receives support for 5 to 7 years with interest subsidies on loan above 7.7%, and member can open saving account. Now what is the lending norm for SHG? So friends, SHG that are active for at least 6 months become eligible for the loan. So that is the eligibility. SHG active for 6 months become eligible for the loan, and they can receive loan starting at rupees 6 lakh for our 3 year, and term loan begins as rupees 1 lakh based on their performance and saving. So these MSME credit scheme and the DNRLM program work together to provide financial support for both business and rural community, ensuring growth and stability. Now let's talk about this what happen when loan are given to the self-help group and the DNULM program support, how daily NULM program support the urban poor. So let's first talk about post credit follow-up. See, after receiving loan, SHG are given passbook to track payment. Now regular meeting, banks should set fixed date to meet SHG for update and support. There is something called joint recovery camps. So what is this joint recovery camp? So bank along with local agency hold camp to assist in recovering loan. Now there is something called bank support. So banks should set SRLM help bank partner with SHG and offer counseling. Subcommittees, you can see subcommittees keep an eye on SHG loan to ensure a smooth repayment. There is something called interest subvention. Women SHG get a 7% interest rate on loan up to 3 lakh, and if they repay on time they get an extra 3% discount. So that is called interest subvention. Now there is something called DNULM, that is Din Dayal Antyodaya Yojana and National Urban Livelihood Mission. It was launched in 2016, and this program focused on improving the livelihood of the urban poor through 5 key components. The first was SMNID, that is social mobilization and institutional development. So it helped the urban poor organize into self-help group for better support. So it helped the urban poor organized into self-help group for better support. There is something called CBNT, that is capacity building and training. So it provides skill training to help people earn sustainable livelihood. And there is something called ESTNP, that is employment through skill training and placement. So it offers training program that leads to job placement. There is something called SAP, that is self-employment program. It gives financial support to start small businesses or micro enterprise, and support to the urban street vendor. So it provides financial help and other resources to a street vendor to improve their work condition. Now what are the special feature of SEP? So self-employment program it is called. So SEP program provide access to credit, technology, marketing support, and even credit card for working capital. And these are the reserved quota. There are reserved quota for women, that is 30%, for SC, ST, SC community and minority 15%, and differentially able individual 5%. So whether it is supporting SHG with post credit follow-up or helping the urban poor through the DNULM, these initiatives are making a big difference. Sorry friends. Now we are talking about how state handle interest subsidy for urban livelihood and SAP loan program. So nodal bank designation, the first topic that we have to discuss. See, each state assigning a public sector bank to handle to manage interest subsidy, and these bank collect and process data through a specific portal, and subsidies are directly transferred to the beneficiary account using DBT. DBT means direct bank transfer, sorry, direct benefit transfer. So every state assigning a public sector bank to manage interest subsidy. And now if we talk about the eligibility for SEP1 loan, so age, you must be at least 18-year-old. First thing, the project cost, so it means that loan can go up to 2 lakh and no collateral is required. Guarantee, so loan can be guaranteed through the CGT MSE. Repayment, you get 5 to 7 years to repay the loan with a grace period of 6 to 18 months before repayment start, that is moratorium period. Now there is something called margin money. So for loan up to rupees 50,000, no margin is needed, remember it, loan up to 50,000 no margin is needed, and if loan exceeds 50,000, a margin of 5 to 10% is required. Now if we talk about the group enterprise, that is SEPG, so at least 3 member and at least 70% must be from urban poor family, that is for group enterprise. And for loan for up to 2 lakh per member or up to 10 lakh for the group, no collateral is required, remember it. A repayment is similar to SEP1 with 5 to 7 year and 16 to 18 month moratorium. Now let's talk about the credit or Mudra card. These cards help cover short term cash need. The norm for issuing this card are set by SULM and SLBC, state level banking committee, with the beneficiary being connected through urban local body. Beneficiaries are being collected through ULB, that is urban local body. Now there is something called CLC, that is City Livelihood Center. So this CLC provides support services like production, marketing, sales, accounting, and they also help categorize loan with a special code for loan under program like SEP1, SEPG, SHG and WSHG. So nodal bank handles subsidies, and SEP loan, whether for individual or group, provide much needed financial support to urban poor family. Right, so we have seen nodal bank and SEP loans. Now let's talk about the next topic, that is Pradhan Mantri Jan Dhan Yojana. So Pradhan Mantri Jan Dhan Yojana and Swavlamban scheme. So the PMJDY scheme main goal is to ensure that every adult has access to basic financial service. So every adult has access to basic financial service, and especially the saving account. What are the key feature? The first is no minimum balance. You don't need to keep a minimum balance in your account. RuPay debit card, that is it comes with insurance benefit, easy fund transfer and even life cover. Then there is something called overdraft facility. So after 6 months of regular usage, you can get an overdraft, that is loan facility, especially if you are a woman, as long as your account is Aadhaar linked and you don't have any other saving account. Now there is something called Swavlamban scheme. So this scheme supports self-employed individual and small traders and artisans, right, that is between age 16 to 65. So for business growth, so here how it works. First of all, let's talk about the target group. So aimed at those ages 18 to 65 year, but it exclude minor and people who have KCC or GCC loan already. Now loan eligibility, so you can get a loan based on either 4 times your average monthly balance or 50% of the amount credited to your account in the last 6 months. So based on 2 things, either 4 times your monthly average balance, that is MAB, or 50% of the last 6 month credit, maximum 10,000. Now interest, the interest rate is capped at 2% above the base rate, and there are no processing fee. Subsidy, any subsidy you are eligible for will be credited to your account, but the DBT, that is direct benefit transfer, get paused when the loan is active. Aadhaar and mobile. So Aadhaar verification is mandatory, and either the borrower or family member mobile number must be registered with the account. Pradhan Mantri Suraksha Bima Yojana. So basically this is an affordable accident insurance scheme offering following coverage. The coverage is rupees 2 lakh for accidental death or full death disability, and 1 lakh for partial disability. Premium, you only pay rupees 20 per year, which is automatically deducted from your bank account. Provider, this insurance is provided by public sector. It provided by the public sector or general insurance companies through banks. Now let's talk about the Atal Pension Yojana. This scheme is designed to provide a secure pension. Eligibility, it is open to all bank account holder or aged between 18 to 40 year. However, income tax payer are not eligible. Now pension, Once you turn 60, you will receive a pension ranging from 1000 to 5000. Now, death benefit: if the subscriber dies early, their spouse can continue contributing on the pension corpus will go to the nominee. Now, government guarantee: so the government guarantee a minimum pension amount covering any shortfall if they return or low. Now, Mudra scheme: this scheme help small businesses grow by providing loan under 3 categories. The first is called Sisu means loan up to 50,000. Kishore means loan between 50,000 and 5 lakh. Tarun means loan between 5 lakh and 10 lakh. Who can apply? Borrower needs to have the necessary skill. There should be no bad credit history, and it must use the loan to generate income. If we talk about the loan types, this include term loan, overdraft, or combination of both for things like working capital, equipment, or marketing. Now, if we talk about the interest and security, Sisu loan are usually free from fee, while interest rate for Kishore and Tarun vary. No collateral is required, and repayment depends on the asset life and cash flow. So, this Pradhan Mantri Suraksha Bima Yojana help protect against accident. APY ensure, Atal Pension Yojana ensure pension for your retirement, and Mudra loan give a small business a boost. Now let's talk about this KVIC, Khadi Village and Industrial Commission. So friends, KVIC focus on creating jobs and boosting self-reliance in rural community. If we talk about the goals of KVIC, it promote employment and self-reliance in the village. Function: KVIC support Khadi and village industries by developing raw material reserve. It help artisan market their product and providing financial aid for growth. Now there is something called Pradhan Mantri Employment Generation Program, that is PMEGP. So it is all about self-employment and reducing rural migration. The objective is to create job opportunities in rural area, to boost income and to reduce migration to cities. How it works? KVIC leads the program nationally, and on the state level it is supported by various agencies like KVIB, DICs, bank and core board. KVIB means Khadi Village Industry Board, DIC means District Industry Center. Who are the beneficiary of this scheme? So, beneficiary people selected by KVIC, KVIB, DICs undergo 2 weeks of entrepreneurship training and are eligible for capital subsidy. Now, there is something called self-help group. So, self-help group or voluntary group focus on economic empowerment through microfinance. Now, purpose: they help member access credit, resources and build a collective pathway out of poverty. What are the benefits? So, SHG encourages a saving habit, provide financial aid and promote entrepreneurship and skill training. If we talk about the members, so each SHG has 10 to 20 members from the BPL family, that is below the poverty line family. If we talk about the SHG bank linkage program, so SHG save money as a group and use that fund to get loan from the bank. So KVIC, PMEGP, SHG are transforming rural area by providing job training and financial support. These initiatives empower communities and drive economic growth. So friends, this was all about our 3 units. Hopefully you enjoy the session. If you really think that this video was useful, please hit the like button, subscribe the channel and share with your colleague. And also, if you want PDF of this, you can enroll in our PPB capsule course program, where I am providing such kind of micro notes on daily basis. Thank you.